Before we start today's work, let me ask if any one of us has some questions based on what we did last time that we need to address before we move forward.
Hello, sir.
Yes, sir.
Yeah, this is Peter.
Yeah, Peter.
Yeah, it's not necessarily about yesterday's one, but the spreadsheet and then the comparative analysis. Just a snappy question.
Okay.
So you made mention of other, is it other income also?
Okay. In the question, right?
No, no, not in the question. In the presentation that you gave, I think after giving the sales cost or whatever, there's some other income also.
Mm-hmm.
The
Okay.
as an aspect of the list. I wanted to find what difference between the other income and the sundry income,
Okay.
because the last that was when the accountant brought something to me and it he stated a sundry income. So I didn't know. So is it the same thing or they are two different issues?
Let me know exactly what your accountant wrote. He wrote two things, right? Let me know the two.
No, so it was the. Me, I don't know that this is the account, this is the analysis that he made. And then after having indicated the various, it's a hospital that I'm working in a hospital.
Okay.
So after, this is me, I don't know. After giving uh, the accounts, like
Okay.
the revenue aspect, whatever, then he stated under it sundry income. And so he was saying that the sundry income is not directly part of the revenue,
Okay. So it
but their
is.
income that he be.
Yes. So
Hello.
he gave you some explanation. I think what he said was right. So he gave you the main income, right? Are you so
Yes.
the main income is the income that comes from the core operations of the hospital.
Yes. Yes.
Yes. But there could be other incomes, okay, that are quite incidental. They don't come from the main
Okay.
operations of the hospital. And when we were holding the lecture, I think last 2 weeks, I clarified it by we gave a manufacturing company as an example. Let's say we produce and sell phones. The income from the sale of the phones, because our core operation is the production and selling of phone, that is our main income, and that is what we normally refer to as revenue. Revenue. Then it is possible that maybe some of our delivery vans, we do not produce and sell delivery van, but we buy delivery van to aid us in the distribution of the phones to maybe the sales points across the country. Some of our sales vans may have lived its useful life, and that we want to sell it off, scrap it, and buy new ones. When we sell the delivery vans, mostly we can sell them at some profit, or even the proceeds from the selling of the delivery van is an income, is money coming into the organization. But it is not income from your core operations. You do not buy and sell delivery van. So we do not want to mix apples with gingers, for example. So we classify. We said when we were given the job of the accounting information system, we said that if it is well designed, it should be able to, in addition to capturing, it should be able to also classify the transactions into the various forms. So we do not mix incomes that do not come from our core operations with incomes that come from our core operations. So that's why he captured all the other income as sundry income. Another term he could have used is other income, just to make it
Thank
clear that
you.
it is
Thank you, sir.
income not from our core operations. Okay, thank you very much for the question. Any other question?
Thank you.
Any other question?
Yes, sir.
Yes, Ezekiel.
Please, it's not a question, but I just want to seek clarification on the assignment you
Okay.
gave us on the financial accounting ratios.
Yes, sir.
The question one, I think, is the question on farm milk.
Yes, please. And
Uh,
the income, the financial statements are attached to the question.
the statement. Okay, so I only have I don't have.
Ezekiel, go to a Google Classroom. What was put on the page lack that aspect. So go to a Google Classroom, you see everything there. Thank you.
Ezekiel, are you on the Google Classroom platform?
Yes, sir. That is why I downloaded the question.
Then
And
maybe you
sorry,
have not.
you left that one out. Yesterday I was there and I saw everything. So go back
Yes,
again. It's
I think
done. It's
it's even
done.
it's
Oh, okay.
down. It's a
Okay.
PDF. I made it a PDF, so I've embedded all of them into one question. So when you scroll to the
Yes,
very bottom,
sir.
you will see the statement there,
Okay.
the income statement and the statement of financial position, which you should use for
Okay.
the analysis.
Okay, sir.
Yeah.
Okay, sir. Thank you.
Okay. Today,
Hello, sir.
yes,
Hello,
Rosemary.
sir.
Yeah, Rose.
Please, I had wanted to ask a question.
Please
The
go ahead.
finance cost, the finance cost in the questions, I hope
Yes,
it's the same as interest payable.
exactly.
Okay,
Finance
thank you.
costs, interest payment, interest charges, they are synonymous terms. Right, so
Thank you.
they mean the same
Then
thing.
also, let me ask this one. The shareholders fund, is it the same as the stated capital?
The stated capital is part of the shareholders fund. The
So when you are
shareholders,
giving stated capital and you
okay,
don't know the shareholders fund, how will you know which one is the shareholders fund?
okay, let me explain that one. The
Yes, please.
shareholders fund is all the monies that belong to the shareholders, and it is made up of what the owners gave to the business as capital, right? Plus any growth
Yes.
in the capital. And the growth in the capital will come in the form of profits that was not distributed to the shareholders to go and chop, but was reinvested in the company. We have a special term that we use for all the profits that are reinvested. We call them retained earnings or retained profits.
Okay.
So the shareholders fund is one, the share capital plus retained earnings.
Okay.
Mainly. There could be other reserves, other monies that belong to the shareholders that could be part of the shareholders fund. Plus, for example, if you have any revaluation surpluses, these are capital surpluses which we do not distribute. All of them will form part of the shareholders fund. But the basic component of the shareholders fund is the share capital and the retained earnings or the retained profits.
Okay. So does that mean that whenever they ask of shareholders fund, you have to use the retained earnings and the stated capital? Do you necessarily have to add the capital surplus?
Yes, if there is capital surplus, they are all they all belong to the shareholders.
Okay.
It's just that
Thank you.
for statutory reasons, there are some funds that it is reserved. They are not distributable to the owners. Like capital surplus, yes, we don't distribute it, so they will always be there. And at the agreement or in agreement with the shareholders, there can be an arrangement where the profits that the company has made, we do not distribute them or we do not distribute all of them. And that one is also put in an account called retained profits or retained earnings. They are also for the shareholders.
Okay.
Plus the money at the start of the business that the shareholders contributed. So all of them added together gives you the shareholders fund or shareholders equity.
Thank you.
Okay. And please, let me say it again. I said you should be watching the video. Try as much as possible to watch the video to the end. And in addition to watching the video, also try to form some teams and discuss so that you'll be able to trash some of the issues out so you can have a good solution. Everybody should involve himself, herself in the discussion, in the watching of the video and the discussion. Do not sit on the fence and then copy someone's solutions and bring it. If you do that, I may not be able to see it, but you are doing a huge disservice to yourself. If you do that, the continuous assessment may show good, but you will be caught up in the exam. And when you fail, nobody can help you. And I know nobody is a failure here, so we will do the right thing.
Hello, sir.
Yeah, Rose.
Hello, sir. Yes.
Rosemary.
About preference dividend.
Okay.
I had wanted to know whether dividend payable under current liabilities is the same as the preference dividend.
No, preference dividends, there can be two types of shares. The share is just an arrangement. It's just a contract arrangement between someone who is prepared to give his money to the company and the company, right? So we can have different contracts. And one of the contracts can be through the ordinary share. Another one can be through preference share. So let me take the opportunity to explain the two. The preference share is, let me explain the ordinary share first. The ordinary share is a special contract between some people who want to give money to the company. Remember that now the company is a person on its own. Yes. So it's a special contract where the owners who form the company give something like a loan. Not, let me put a loan in quotes. Okay. They give money for the company to run with the money. And the agreement between the owners and the company is that these monies, you are not meant to pay them back. You can use them for life. All right. And you will have to pay as dividend. Even the payment of the dividend is not really by force. When things have not gone well, you, the company, can tell us you will not pay us any dividend. So you see that is an arrangement that is like those who are giving the money to the company is not getting any special deal. The deal is not that lucrative, not profitable, because if the deal is that, oh, when you get money, then you can pay me dividend, then why should I give you the money? If the deal is like, I give you the money, and then I'm not supposed to take it back in any time soon, because of that huge risk that the people who give such monies to the company, incur. They are also giving some special rights that others are not given. They are given the right to dictate the direction of the operations. They make the operational decisions. They decide how the company is run. They have the highest contribution into how the company is directed. They are the ordinary shareholders. And the money they give to the company is what we describe as the equity shares. So that's the arrangement they have. So the company has several arrangements with different people. We have talked about one. Then the preference shares is also shares, but that one doesn't behave exactly like the ordinary shares. This one is like the people are saying, no, we cannot take the risk where when you like, then you pay us dividend. When things are not going right, you don't even pay dividend. We can't do that. So the preference shareholders are paid determined and fixed rates of dividend on their monies. It's just like the creditors that we pay them interest. Yes. So they don't have much risk as the ordinary shareholders have. Yes. So that is their arrangement with the company. Then, apart from the preference shareholders, in addition to the equity shareholders, there could be other creditors, like maybe someone who wants to give big money for a long term to the company. Normally, the company will float what we call debentures. It's also a contract arrangement where the company says, give me big money for a very long time, then I'll pay you interest every period. Plus, after the term of the agreement, I pay the principal back to you. And some people like that. They don't want to take as much risk as the ordinary shareholders will do. So there are also a group of people who put their money, give their money to the company, and the arrangement is like that. Okay. So the question you asked, whether you said preference shareholders the same as?
No, I asked whether preference share dividends is the same as dividends payable.
Okay, preference share dividend is the dividend that is paid to the preference shareholders. Now you understand we can have two types of shareholders. The ordinary shareholders and the preference shareholders, and they are different. Yes. The dividend payable, the word payable means that it is dividend yet to be paid. It is most likely to be an ordinary dividend. So it means that the dividend that is paid to the preference shareholders will be called preference dividend or preference shares dividend, whatever you want to call it. And the dividend that is paid to the ordinary shareholders will also be called ordinary dividend. All right. In this particular case, I think there is no qualification as to whether it is ordinary dividend payable or preference dividend payable. If it is like that, mostly it is ordinary dividend payable. Dividend payable means that it is dividend yet to be paid. So it is a liability, it's an obligation on the company. That's why you see it at the liability side. Yeah, that's just what it means. But it is dividend that is to be paid. Yeah.
So it means we cannot use that one as a preference dividend.
No, because the question didn't specify it to be preference dividend. It just said dividend payable. It is most likely to be an ordinary dividend, which is to be paid, which is an obligation to settle.
So when something like
but check the statement.
Tax, where something like profit after interest, tax, and preference dividend.
Yeah.
Does it mean that where they've written the preference dividend, it should have been from the P&L statement?
Exactly. But check this particular statement. Check the financing side, the equity side. Did you see that the company has preference shareholders? Do you see any preference shareholder there on the statement?
No, they only wrote stated capital and retained earnings.
Okay, that is for ordinary. They
didn't write any preference shareholder anywhere.
Okay, that's for ordinary shareholders. So it means that this company is not financed by any preference shareholder. But in terms of
so when
formula,
they ask a question and they add preference dividend aspect to it, it means they are just asking it. Like, return on shareholders' funds is calculated by profit after interest, tax, and
preference dividend.
Preference dividend.
Yeah. This is the reason why it is like that.
If the question is not having preference shareholders, and they ask
that one is they are giving you. Let me explain.
Yes.
We are giving a complete formula, okay? But where something doesn't apply, that thing that doesn't apply is taken away from the formula. This is what it means. Return on shareholders' fund. You want to know that, okay, I'm trying to look at the money that the shareholders have put into the company, stated capital plus retained profit. Let me match it with the profit and try to do some calculation about how much profit that only shareholders fund is bringing.
Okay.
That's the ideology behind that kind of assessment, that kind of calculation, right?
Okay.
So when we are to do that, it will make sense that the profit is also a profit that is profit which is linked with the shareholders. Profit after we have paid preference shareholders. Profit after we have paid the government, because you see, what happens to the ordinary shareholders is that they are residual recipients. It is after everybody has been paid. Everybody has been paid that if there is something left, then they get something. Yeah. So if we want to assess the return on their investment, we do it the same way after everybody who needs to be paid has been paid. After we have paid the government the tax, after we have paid interest to other creditors, after we have paid preference dividend to preference shareholders, then the profit that will remain divided by the shareholders fund gives us a very good assessment of return on shareholders fund. So that's why the formula is like that.
Oh, okay. Thank you, sir.
Are you okay now? Okay. Ezekiel. Yes, sir.
I think I have seen the video on financial statements.
Yes, sir.
But that of the accounting ratios, I don't know whether you attached that one too.
Yes, it's already there or it's not there. It's already there. It's on your platform. So you will see them as financial statement analysis part 1. The part 1 encompasses horizontal analysis, vertical analysis, and trend analysis. Then there's another video which is titled Financial Statement Analysis Part 2.
Okay.
Yes, they are all on your platform. That one is on ratios.
Okay.
So when you watch that video, you will be able to deal with all the ratio questions. Fantastic.
Okay, sir.
Okay.
Thank you.
Okay, so thank you very much for your questions. Today, we are going to look at the concept of cost volume profit analysis. Cost volume profit analysis. Cost volume profit analysis. In business, when we are producing and selling, we do so for profit. But this is what we have to note. Before we produce, we incur costs. And then, after we have produced at a certain cost, we sell them. The volumes that we can sell, they vary. Sometimes we can sell more, sometimes we can sell low. And all of these things have effects on our profit. So just as the topic is stated, it's just a short-term analysis where we try to see how these variables, the costs of operations, the quantity that we sell, and the profits that we make, how they are related. So that we can know that, okay, if our cost is like this, then we have to sell this volume to be able to get this profit. Or if our cost goes down or goes up, then volume needs to be adjusted this much to maintain this profit or to get this targeted profit. Basically, that's how the analysis goes. And it's a very useful tool. And I must emphasize it's a short-term decision tool. In the long term, as experts think, in the long term, there is nothing like fixed, there is nothing like variable. In the long term, we are all the same. It's only in the short term that someone can be richer than the other. That's what they say. So this is a short-term decision. It is assumed that in the short term, there is a division between your cost structure as to fixed and variable components, which have influence on your profitability. So that's what we're going to do. For us to get a good understanding of this topic, we will have to go back a little bit. And this one, it doesn't matter whether you are an HR student, you are a finance student. All of us have done something like that before. So we are going back to marginal costing. Because we will borrow some principles of marginal costing to do this kind of analysis. So let me put it to the class. What is marginal costing? Someone with any idea, just any idea, then we pick it from there. Marginal costing. Okay, so marginal costing is a method of assessing the cost of a product where we think that it is only the variable costs, the costs that change as we produce, that should be part of the product cost. That is marginal cost, marginal costing. So if we have something like, if you have produced a product and these are the costs, let's say salary of MD, cost of raw materials, wages for direct labor, direct expenses. So these are the costs that we incurred. If we want to put a cost to the product, marginal costing is saying that it is only the cost which behaves like when we produce more of those costs are incurred. When we produce less of those costs are incurred. Only the costs that behave in that fashion. That should be part of the product cost. In other words, costs that will stay the same whether we produce or we don't produce, whether we produce this volume or we produce that volume. That one has nothing to do with the product. That's the ideology. So it doesn't make sense for that cost to find itself in the costing of the product. That's marginal costing. That's what they are saying. So if we look at these cost items, which one or which ones will be made part of the product cost based on marginal costing thinking? It's a question to the class. You tell me your name and then I give you the chance to talk.
Miss, I'm Stephen.
Yes, Steve.
Cost of raw material.
Cost of raw material, good. That is a variable cost, because if we produce more of the product, we will need more of raw materials and that the cost of raw materials will go up. So it is a cost that behaves like if we produce more of it is incurred. If we produce less of it is incurred. Which other
Please,
one?
Agnes.
Yeah, Agnes.
Wages of direct labor.
Wages of direct labor. And we all understand. If you don't understand, please you let us know so I can explain. Which other one again?
Direct expenses.
Direct expenses, good. So, what would you say about this guy? What would you say about him?
Sir, this is Peter.
Yeah, Peter.
Yeah, sir, I would say that no matter what happens to the production, for the salary of the manager still remains the same.
Exactly. The MD salary, whether we produce one of the products, he takes the same salary. Whether we produce 100 of them, he takes the same salary. At least within some period, his salary is fixed. It doesn't change with respect to changes in the output, with regard to changes in the production level. Whether we produce 0, produce 1, produce 2, produce 1,000, produce whatever. Within a given time, the MD salary is the same. So MD salary is a fixed cost in relation to the production of the product, at least within a given period. So marginal costing is saying that this one should not be part of the product cost. In other words, it is not a product cost. The Americans will say it is not an inventorial cost. That's what it means. In fact, this is the basic concept within marginal costing. So marginal costing, when they are preparing their income statement, this is how they do it. Let me first present the traditional income statement. That one is based on absorption costing. But with due respect to my HR and marketing people, if you don't understand absorption costing, don't worry at all about it because it's not part of what you should know for the exam. I'm just saying it because there are two schools of thoughts. We are talking about marginal costing now. There are some people who argue against this. They belong to the absorption costing side of the issue. Absorption, and mostly the income statements, like the Fan Milk statement you are seeing, the Guinness one that I gave you, they are all prepared on the absorption costing principles, not on marginal costing. The marginal costing is quite used internally for management to get certain kind of things and take internal decisions. Alright, so absorption costing, this is what we'll do. Revenue. You can check one of the income statements that you have in your question. Revenue, let's say this is the amount. Then we have cost of sales. This cost of sales is a direct cost. The cost that is close to the manufacturer of the product. Some can even be fixed, but once they are close to the product, they still are seen as direct to the product. This gives us what we call gross. When we subtract this, we get gross profits. Gross profits. Then we come to subtract other costs or other costs that are not too direct. And these other costs, they can be variable, they can be fixed. Once they are not direct to the product, they all come. So this is the structure that we use for the traditional income statement. The marginal costing people are saying that because there is much importance attached to whether the cost is variable or fixed, we cannot prepare the income statement this way. So this is how they prepare this. After the revenue, they will subtract all variable costs, whether it is a direct or it is not direct. All variable costs. Then when they subtract all variable costs, they get an equivalent of the gross profit but they don't call it gross profit. They call it contribution. Contribution because we have subtracted only our variable costs. We have not recovered any fixed costs. So the profit that we have had at this level is a profit that is going to contribute towards the recovery of our fixed costs. That's how come they call it contribution. So contribution. Then they come, you will see that after getting the contribution, all the costs that will be remaining will be fixed costs. So all fixed costs are now subtracted, and then we get our final profit. Okay, so one of the things that I want you to also get as a tool to be employed in the CVP analysis is the concept of contribution and the way it is computed. It is revenue minus variable cost. On per unit basis, on one product basis, contribution will be computed as selling price minus variable cost per unit for one unit of the product. This is like for the whole of the units we have sold. So total revenue minus total variable cost gives us total contribution. But you can do that analysis on unit by unit basis. On unit by unit basis. So if you take 1 unit of the product, the selling price of the product minus the variable cost inside the product gives you contribution per unit. Right? Any questions so far? This is the part of variable costing that we need to help us do our cost volume profit analysis. Any questions so far? Question? Okay. No questions. So let's proceed. In fact, all this information I'm showing you, I have them on your platform. There is this sample lecture note with some examples. I have posted it on your page already. It has been there since. Because I use the same thing to teach the sandwich students. They took the same course as you are taking. Okay, so this is cost volume profit analysis. The notes will be left for you to read the meaning of it. As for the meaning, I've explained it, but you can read to solidify your understanding. Assumptions underpinning cost volume profit analysis is for you to read. If you read and you have any queries for me, you can do so. You can send me your queries. Advantages, you have to read. Limitations, you have to read. This information is already on your platform. Then, let me also emphasize that we are going to deal with this kind of assessment, cost volume profit analysis, aka CVP analysis. We're going to deal with it in 2 levels. The first level is where the organization produces and sells a single product, so single product environment. But that is quite unrealistic because most companies, almost every company in the world, produce more than one product, produce and sells more than one product. But first we'll look at a situation where the organization deals with only one product. Then the next level will be where we try to see it from multiple product environment. We try to be more realistic because that's what most companies do. They produce and sell more than one product. So the first one we're going to do now is single product environment. So this lecture, because the note is there, you will see it just as I have done here. I'm showing you here. Cost volume profit analysis. In fact, I should have added the fact that it is for single product environment. But no problem. The lecture notes that one is also there. The one on multiple product environment, that one has been qualified. So you'll see cost volume profit analysis, multiple product environment. So that can help you to distinguish between the two. The one without, whether it is multiple product or single product, is single product. The multiple product it is clearly there as multiple product. And for that reason, all the things here, the assumptions here, the advantages here, most especially the assumptions here, they pertain exclusively to the single product. When we go to the multiple product, it may have its own assumptions. Some of the assumptions here may hold still for the multiple product, but when you read, you have to see where this one doesn't apply to this one. That's for you. You have to read. You are master level students. Okay. So let's try to see how the analysis goes. We want to know, first of all, if this is our cost structure. What volume or what quantity should we produce given our cost structure to get, first of all, zero profit? Zero profit means that we'll be able to pay for all of our costs, but will not have anything left as a profit. To be able to pay for the materials, the labor, we'll be able to pay for ourselves as entrepreneurs. Everybody is paid for, but the company does not have any profit for reinvestment. We'll look at a situation like that. If this is our cost, we want to get zero profit. So what volume should we produce and sell? Because we are going to look at the relationship between the two key variables: cost, volume, and profit. From the zero profit assessment, because no organization is interested in zero profit forever. You may be interested in zero profit at the very beginning of your operations. That's why we'll assess that kind of position. But ultimately, we want supernormal profits. That's what economists describe it: supernormal profits, beyond zero profit. So we'll extend the analysis. Okay, this is our cost structure. Given this cost structure, if we want to get this target profit, not zero profit, what volume should we produce and sell to get there? That's basically how the analysis goes. And it is quite simple. Let's try to see it. This one we all know from what we learned, I think, in lecture 1, the income statement, how it is prepared. From how the income statement is prepared, revenue minus costs is equal to profit. Is this correct? I need to hear your voices. Is it correct? Yes. This is the equation underpinning the preparation of the income statement. All our revenues minus all our costs, then we are left with our profit. Okay. We can break this broad equation down as, revenue is how much we sell one product. Let's call it selling price per unit, times the quantity we have sold. Let's represent the quantity by kilo. So this is a mathematical expression of revenue. Are you okay with this? Are you okay?
Yes, sir.
Okay. Minus, we are not changing anything, so this is equivalent to this. Minus cost. In the meantime, let's say it is variable cost plus fixed cost is equal to profit. So they are the same. Now let's see it's further broken down again. Selling price per unit times quantity, which gives us revenue, minus variable cost also relate with the quantity. The quantity influences the variable cost. They have a relation, just like the revenue. So we can break this down as variable cost per unit times quantity. That gives us total variable cost. Let me bring T here. This is total variable cost. Now plus fixed cost. Let's bring T here. Total fixed cost. Total fixed cost is equal to profit. If you have a question on how we are deriving the formulas, you can ask me now. I am pausing. Because if you understand what we are trying to build now, if you get the understanding, by no means you could be tricked by any CVP question. Yes. I don't believe in giving you formulas. If you want to get this is the formula. No. So we are taking some pain to derive those formulas ourselves. And once we derive them, it means we understand them. We know why they appear the way they appear. And if you are in that situation, it makes it easier. You understand the formula. You wouldn't have to chew it and forget it, misquote it, and so on and so forth. So any questions so far? Yes, sir.
So yeah, we have SP. Selling price per unit times key minus total variable cost plus total fixed cost. Now coming down. We only pay the variable cost per unit. What happens to the total?
Come again.
I said you give us selling price per unit times quantity.
That is the revenue.
Yeah. Total variable cost plus total fixed cost.
Yeah.
Yes, and then you came down again by here. I saw only the variable cost. The total is not there, and I wanted to find out.
I explained it as this. Total variable cost, okay, is equal to variable cost per unit times quantity. Because variable cost relates with the activity level. The more you produce, the more variable cost you incur. When you produce more, total variable cost increases. When you produce less, total variable cost reduces. So variable cost relates with quantity, and therefore this total variable cost is arrived at by multiplying variable cost per unit for 1 unit of the product multiplied by the total unit of the product. You understand? So this one is the same as this. Are you okay? I hope you're okay now. If you're okay, let me know. If you're not okay, let me know. Okay, so let's proceed. So we now can go still further down. Selling price per unit times quantity, that's the revenue, minus, and see how I'm doing it. When I put it in bracket like this, I'll use the plus because I want to add this to this before we minus it. But I can also write it like this: minus variable cost per unit times quantity minus total fixed cost is equal to profit. If you have any misunderstanding, let me know. Your silence means that you are okay, you understand fully what I am doing. If that is not the case, let me hear your voice.
Exactly, sir.
Sure. So, from our basic mathematics, we learned something called like terms. I understand that most of us have lost some of those principles. By like terms, simply means that these variables Q are here. Okay, so they move together. They are family people. So we group all those things on one side, and then we take all the other things that do not have those commonalities also on the other side. The side is defined by this equation sign. So these guys that have the kill, they're already on one side of the equation. It's just this guy who needs to be removed from here to a different place. So rewriting based on that kind of grouping of like terms will result in us having this equation as this: selling price per unit times quantity minus variable cost per unit times quantity is equal to total fixed cost plus profit. That's what we get. And now this Q is here, this Q is here. It means we can bring this Q out, rewrite this whole expression as Q out SPU minus VCU. It's the same, we have not changed anything. If we expand the brackets, we'll come to get what is on top. Because our target is that we will want to know the volume that we will need to produce and sell given our cost structure. That's why we are trying to modify the formula to get Q standing on one side of the equation. Then we will get to know, okay, this is the expression for Q. If you want to get the volume that we need to produce, this is the formula that we should use. So Q out, selling price per unit minus variable cost per unit, is equal to total fixed cost plus profit. Then, if you want Q to stand on one side of the equation alone, not mixed with anything, then we need to remove this guy from Q. Removing it is done by dividing this whole expression by what we want to remove.
Hello, sir.
Yes, sir.
Please, can you explain again the total fixed cost? Why we are adding it to it, and then
Okay.
separate from the.
What's your name, please?
Ezekiel.
Ezekiel. Good. Good for your question. Please, who can help Ezekiel? We are learning together. Ezekiel missed the step where we said we can rewrite this one as this one, so that we now come to have total fixed cost added to profit. He doesn't understand why this one has now become the case. Who can help?
Yeah, this is Peter.
Yeah, Peter.
Yeah, you said at that instant we have to look at the like terms and then we group them. But we got to know that the SPU times Q and the VC, but they are already at one point. So it is the TFC, total fixed cost, that has to be moved to the other part of the equal sign.
Okay, thank
So
you.
that's how we see that equation.
Thank you very much, Peter. So, Ezekiel, from some mathematical principles, okay, this one is becoming like the way it is because we are applying some mathematical principles. Mathematics is saying that we have this, okay, we have this, we have this, we have this. These things that we have, we should check whether they have commonalities. For example, it's just like saying that, okay, let's look at our root names, our surnames. The surnames, if you trace them, our surnames, it will be traced back to one source. For example, my surname is Ado. If you trace all Ado back to the origin of Ado, it will point to one person. That's where it originates from. So we are kind of doing some kind of, okay, let's group ourselves according to our surname, because if you have the same surname, we may belong to the same place. So see these guys. They have this surname, Q. This guy also has this surname. It doesn't have the surname Q. This one also doesn't have the surname Q. And the reason why we are interested in the surname Q is that look at the reasoning behind what we are doing. We are saying that given a particular cost structure, what volume should we have to produce to get some profit? So we have our eye on the volume. The volume is represented by Q. So we are trying to group all the things that have Q with them. SPU times Q has Q with it. VCU times Q has Q with it. So let's make them stand on one side of the equal sign. So that's what we did. SPU Q, VCU Q on one side of the equal sign. This is the equal sign. Then all the things that do not have Q, they should also go to the other part of the equal sign. This one, this guy, profit, is already at the other side of the equal sign, so no problem with it. So we made him stay there. But TFC was at the left-hand side initially, and we have to move him to the other side of the equation. It has negative before him. When he is crossing the equal sign, it changes to become positive. So we have positive TFC plus profits. Ezekiel, I hope this one is okay for you.
Yes, sir.
Yes, sir. Okay, so that's how come we have this. Apart from that, are you okay with what we have done following that one?
Yes, sir. Yes.
Okay, so we want to remove, we rewrote this one as this. Q out selling price per unit minus variable cost per unit in brackets is equal to total fixed cost plus profit. And now we have our eye on the Q. We want to make the Q stand alone on one side of the equation, because that's the value we want to look for. To make Q stand alone is to remove SPU minus VCU from Q. And we do that by dividing the whole of this by what we want to remove. And if we will be in equation, if we will be in balance, then what we do here, we must do the same thing at the other side. So we divide here, SPU minus VCU, this takes this one away. And we divide the right hand side also by the same expression. So we'll end up getting Q is equal to TFC plus profits, all divided by selling price per unit minus variable cost per unit. Okay, so this is the generic formula, and this formula underpins all other analysis we will do. If you understand how this formula is derived, there is no question in CVP that you shouldn't be able to solve. This is the generic formula. We will modify this formula slightly to get just everything we want. So to get the quantity, the volume that we need to produce and sell, to get any profit, zero profit, targeted profits before tax, targeted profit after tax, whatever it is, this is the formula. So let's take it one by one. So 1, if we want zero profit, then we put 0 here. We put 0 here. If we want something other than 0, then we put that thing other than 0 here. This is not a fight. It's very cool. So 1, if we want to get 0 profit. We might not want to get 0 profit. What I mean by we want to get 0 profit is that let's assess the 0 profit situation. That 0 profit situation is what we call the break-even point. Break-even. Break-even means you have been able to pay all your costs, nothing left. You have broken even. Okay. So you can say that break-even quantity to produce and sell to get 0 profit. You just substitute 0 here. That will be total fixed cost plus 0, all divided by selling price per unit minus variable cost per unit. In other words, break even break-even quantity is equal to total fixed cost. 0 is nothing. So total fixed cost divided by selling price per unit minus variable cost per unit. And before I forget, this expression, you know the meaning of it, right? What's the term for this one? Selling price per unit minus variable cost per unit. This is coming from marginal costing. We learned that one before we came to the analysis. What's the name for it? Contribution. Good. But you see, it is per unit per unit. So how would you call it to be very specific?
Contribution per unit.
Exactly. Contribution per unit. Or unit contribution. Contribution per unit. Unit contribution. Contribution per unit. So if you are reading from textbooks or any other source, and then you see total fiscal divided by contribution per unit, please don't say I didn't teach you. They are the same. Selling price per unit minus variable cost per unit is the same as contribution per unit. And try to also connect the terms with the formula as we are going along. So this is 1. Now we are finished with assessing the break-even position of the organization in terms of the quantity to produce and sell. The quantity to produce and sell to break even will be determined by total fixed cost divided by unit contribution. So that is it. Yes, sir.
So it means that the break even, the quantity that you must sell to break even.
Please, can you come again? Your connection is poor. Can you come again?
I'm asking that break-even point, where you have to sell a quantity, a number of quantity to break even.
Yes, sir.
That is, if you know your contribution, you can substitute the selling price per unit minus variable cost instead of writing the whole thing.
Okay, so I don't really get you, but if I'm right with the way I understand what you are saying, if you have contribution, let's say in the question, right, you have unit contribution there, and you also have selling price per unit, variable cost per unit there, you do not have to come and recalculate the contribution because it's already there. You slot it in there, all right? Because let's say in a given question, we have been given the unit contribution as 2 cedis, for example, and then we also have information on selling price per unit. It is, let's say, 8 cedis, and then variable cost per unit is, let's say, 6 cedis. These two was derived from subtracting 6 from 8. You can do it in this form by 8 minus 2, or you can pick this one straight away because it's the same thing. Is that what you are saying?
Yes, sir, that's what I'm asking.
Exactly. It's a formula work. This 8 and 6 is the same as, is equal to 2. 8 minus 6 is equal to 2. So if you want to do 8 minus 6, that means that you will just be doing extra work, which is not necessary. If the 2 is already there, pick it and go. Okay. So let's take a question and try to see how it goes with this kind of formula we have derived for the break-even assessment. And when you are reading actually this is a book I wrote, and I just took a chapter on that one for you. There are a few typing mistakes, so when you are reading, you need to be aware of those things. Okay, so let's take this simple question. Right? Then we will do the part that fits what we have just done. we'll break it down bit by bit in that fashion. Frankfurt Motors, you can forget about the name. It's maybe some company that deals in selling of vehicles. Frankfurt Motors is a small car dealership in Kumasi. On average, it sells a car for 27,000 Ghana cedis, which it purchases from the manufacturer for 23,400 cedis. Each month, Frankfurt Motors pays 48,200 Ghana cedis in rent and utilities, and 68,000 for salespeople's salaries. In addition to their salaries, salespeople are paid a commission of 600 for each car they sell. Frankfurt Motors also spends 13,000 Ghana cedis each month for local advertisements. The tax rate for Frankfurt Motors is 25%. We can forget about the tax rate in the meantime. We have not reached there yet. So given this information, these are the questions. How many cars must Frankfurt Motors sell each month to break even? We have just finished the break-even situation assessment. We know the formula. We know the logic behind the formula. Now, do justice to this question. So I'm giving you 5 minutes to attempt the question. I'll call people at random to present their solution, and then we will discuss it. That's how we are going to do it. There has to be student participation in the lecture. So 5 minutes, do your workings, please. You can discuss among yourselves. Hey, you are not discussing? Or you believe in solo work?
Humphrey.
Yeah, Humphrey.
Humphrey.
Yes, sir.
I'm yourself. I'm finding something for you.
Okay, so let's look at this way. Let's all look at the total fixed cost.
How
Every
did you
month he pays 48,200 in rent. That is a fixed cost because every month you'll be paying. And then the salary is also 8,000. That means every month you have to pay for their salary. So that one is also part of the fixed cost. But what will be the variable cost here will be the 600, which depends on the total quantity of cars that are sold. And then one of the fixed costs will also be the 13,000. That means every month he spends 13,000 on the local advertisement. So the total fixed cost will be 48,200 plus 68,000 plus 13,000.
Please, as he is trying to explain his understanding, where you think you need clarification from some of the things he's saying. Oh, why is this, that, and so on and so forth. You can ask. I want you to get that. It should be a forum, discuss. So anybody at all, not only the two people who communicated soon. I want to see the ladies' voice. Ladies, why are you not talking?
Yes, I think per how he started things, he explained as he went along. But my question, Humphrey, what about the sales commission? What is that cost?
The sales commission, that's what I said is the variable cost, the 600.
Okay.
Because it depends on the total number of cars that will be sold in the month.
Okay.
So it may vary depending on the cars sold each month. So as we compute, what is the total fixed cost now? If someone has computed for us.
It's 129,200.
Humphrey,
Yes, sir.
please, I beg you, let me intercept small. Where are the rest of the class?
He said,
Oh,
yes, seriously working now.
they are doing their own
So
work.
we are all around.
Yes, seriously working now.
I
So
will
we are
be.
listening to
We
them.
are here.
We are
So
here.
are you interested in the discussion? That I was thinking all of you will be involved in the discussion, or
Yeah, we're
you.
following
We are
suit, sir.
listening to them.
Tell us.
Okay, but
We have break
don't
in the
just
line.
listen. Don't just listen. Add your voice, okay?
Okay, sir.
Add your voices to it.
Okay.
Okay, sir.
Okay, Humphrey, you can go ahead.
Okay, sir. So now we have our total fixed cost. That is 129,200. Then we have our variable cost, which is the 600. And then we also have our selling price, which is the 27,000.
Yeah.
So I think we can now compute the total number of quantities that has to be sold in order to break even. That will be equal to.
One thing, let me come in if I'm right. Humphrey.
Okay.
And that be 129,200 over 27,000 minus 600. Is that right?
Is that not reversal? Madam Rose, is that right?
Humphrey.
Peter?
Yeah. Is
Yeah, I
that okay?
think that is right. Oh.
Okay.
Okay,
Then
5 minutes. 5 minutes is up. In fact,
Let it 1 minute. I can't need to.
1 minute. Okay, so let with 1 minute. Yeah.
Humphrey.
Yeah, the final answer.
Humphrey.
Yes, sir.
I watch 5.
Yes, you get 4.89. That's approximately 5.
Yeah, 4.89, yes. Approximately 5.
So that means
That's 4.89.
okay. So that means transport motors have to sell 5 cars every month in order to break even.
Okay.
There we are done.
Thank you very much. And I think, please, you can mute your microphones. I just want everybody to see how beautiful it is when we discuss. And you can use the same thing as you just did to try to do the assignment. So you can hold some. In fact, the link I gave you is a static link. Even in my absence, you can log in and discuss it. One person can initiate the meeting. Maybe you can agree on a time. Then you can click on the link to meet yourselves on the same platform. And then you can discuss, oh, okay, when I was solving it, I'm thinking this, oh, I also think this, blah, 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 blah. That's how we learn. Then small by small, we'll make progress. This is something we can utilize if we will not get time to meet physically. All right. Okay. So let's look at the solution together. Thank you very much for what you did. So now we go back a little into variable costing. That is why we did that thing before coming to the actual topic. So we should be able to know. We should be able to. Please, someone has his microphone on. Please make it go off. You should be able to itemize all your variable costs, itemize all your fixed costs. Know your variable cost, know your fixed cost, so you can get your contribution. And that's all. That's all the analysis requires. And I saw you do that. Please, if you have your microphone on, please let it go off for us. I beg. So let's analyze it. The company sells a car for 27,000. One car on the average. So that is the selling price per unit, right? That's the selling price per unit. Or you don't agree? If you don't agree, let me know.
Yeah, agree.
So that's the selling price per unit. Now we need to get all our, let's look at our variable cost first. And when you are assessing variable cost, you assess it in relation to the activity we are doing. This is car dealership, selling of cars. So which costs will vary as we sell cars? Which costs will stay the same whether we sell cars or not? That's how you do the assessment for whether a cost is variable or not. The experience I've had is that most students don't get this kind of thing correct, because they do the assessment of whether a cost is variable or not against no activity. They do it in isolation, and that can get you confused and you can get it wrong. You do the assessment against an activity. The activity could be weeding. The activity could be schooling. The activity could be feeding. In this particular instance, the activity is selling of cars. So we look at all the costs. The purchase costs of the car. Is it a variable cost or a fixed cost in relation to the car selling business? Purchase cost. I'm asking you, it's a question. Franco Motors purchases a car at 23,400 from the manufacturer. Is that cost a variable cost or fixed cost? Vivian. Hey, what's the name? Veronica. Veronica was absent yesterday. Is she still absent today?
Sir, please, you mean Veronica Menu? There are two Veronicas.
Okay, Veronica Menu, and which Veronica again?
Oh, she's in accounting, I think. Okay. She's
So,
not around at the moment, though. She's been called to the office.
So Veronica was not part of the class yesterday. Veronica is not part of the class today.
Yes,
and
please.
I don't even know whether she was part of the last week's lecture.
She was part of the last week's lecture. She was part.
Okay. The risk is that if the trend continues, she's absent, then there will be no knowledge for her. She wouldn't understand what we are doing. And how would she be able to, without understanding, answer questions in the exam? Okay. So anybody at all can respond to the question. The purchase cost of 23,400, is it a variable cost or fixed cost?
Variable.
Variable cost. If you don't understand, good, it's a variable cost. If you don't understand why it is a variable cost, let me know so we explain for you to understand. So let's try to. Hello?
Yeah, sir. Why is it variable?
Your name?
Please, I don't understand.
This is Peter.
Okay, Peter. And then the one who said he doesn't understand just now.
Mildred.
Mildred, okay. Mildred. We buy and sell cars, okay? We said that a variable cost is a cost which increases when we do more of the activity we are doing, and which decreases when we do less of the activity we are doing. So we are selling cars. When we sell more cars, in fact, we buy and sell cars. That's the activity. It's a joint activity. We buy and sell cars. When we buy, and of course we can sell when we have bought. When we sell more cars, when you sell more cars, would you see the costs associated with purchasing the cars to be going up, or it will stay the same? But selling more cars means you need to go and buy more cars. So let's tackle it from buying more cars. When we buy more cars, the purchase cost of the cars, the total purchase cost, will it increase or it will stay the same? In other words, it will increase. In other words, let's say this 23,400 is for one car.
Yes.
When we bring another car, will the cost stay the same as 23,400 or it will increase?
It will increase.
When we bring another more car, will it increase or it will stay the same?
It will keep increasing.
Okay. So let's say for a period, we bought 5 cars. The cost will increase as we add on up to the 5. In another period, you understand it now?
Yes, please.
Exactly. So this cost, the total purchase cost, behaves in this way. When we buy more cars, the total purchase cost goes up. When we reduce the number we are buying, it also comes down. That makes it a variable cost in relation to the buying and selling of the cars. Are you okay?
Yes, sir.
Yeah. So let's come back to our drawing sheets. And then we are trying to say, we know the selling price per unit. It is equal to 27,000. Then we are doing variable costs calculations. It is made up of multiple things. So let's capture all of them. First one is purchase cost. It is 23,400. Now let's go back to the question again. Each month, Frankfurt Motors pays 48,200. Let's look at that one. 48,200 in rent and utilities. Is it a fixed cost or a variable cost? Do the assessment of whether it is fixed or variable in relation to the activity of buying and selling of the cars. Yes, it's a question.
Sir, it's a fixed cost. The rent aspect is a fixed
Cost.
Okay, it's a fixed cost. Are we all in agreement? So,
Yes.
rent and utilities. It is 48,000. What is the cost? 48,200.
48,200.
Okay, it's a fixed cost. Let's go back to the question again. And he also pays 68,000 for salespeople salaries. Is it a fixed cost or variable cost?
Fixed.
It's a fixed cost.
If you don't understand why it is fixed, please let me know. So I'm only responding to where people don't understand. If we all understand, there is no need for me to explain. So salaries, 68,000. In addition to their salary, salespeople are paid a commission of 600 for each car they sell. Variable cost, fixed cost.
Variable cost.
Okay, so we all understand why it's variable, right?
Yes, please.
Yes, because this commission, the commission cost, it will increase as more cars are sold. It comes down as less cars are sold. So it varies in relation to the activity of buying and selling of the cars. So we go to variable cost section, commission, 600. Frankfurt Motors also spends 13,000 each month for local advertisements. Fixed or variable?
Fixed.
Fixed. Are we all in agreement that it is fixed?
Yes, sir.
Do we all agree that it is fixed? Okay, any other item, of course, that's all. So now we can tally them. Our total fixed cost will be the sum of all the things we have itemized as fixed cost. So what will be the total for this?
128,000.
128,000.
28,000.
Pepe. I think there's some 200 somewhere. Please check and give me, confirm the value.
9,200.
100 and 100 and what?
29,200.
29.
129,200. Good.
200.
Good. Then we have our total variable costs. And remember that this actually I'm wrong. This is not total variable cost. This is variable cost for a car. For one car, purchase cost plus the commission for selling one car. So this is variable cost per car. In other words, variable cost per unit. Understand exactly what we are doing. This is one car, not for a number of cars. This is a commission on the sale of one car. So this will give us 24,000, right? 24,000. This is variable cost per unit. And this is total fixed cost. This is variable cost per unit. This is total fixed cost. Okay. So with this done, and this is basic mathematics, this is actually not something that should to give you trouble at all. Now we have this. Let's go back a little. 1. Assessing the break-even situation. The formula is total fixed cost divided by contribution per unit, selling price per unit minus variable cost per unit. We have our selling price per unit 27,000. We have our variable cost per unit 24,000. So we can get our contribution per unit from that. We have our total fixed cost. So we are done. So yes, sir. Yes, sir.
Please. The salary.
Okay. Please, your voice is far away. We can't hear you.
I mean the fixed cost.
Okay.
Advertisement and the salaries. Hey, this question that we are classifying as fixed cost, or in general, it's fixed cost.
What do you think? I told
what
you.
I'm thinking about the.
I told you that you assess a cost as variable or fixed in relation to an activity in question. So there is nothing like what you are saying in general. There's nothing like general. If it is fixed here, depending on the activity that is happening, it could be variable. But in this particular instance, so I can't give you an answer as salaries and adverts is forever and everywhere, every situation fixed. No, there's nothing like that. But in this particular circumstance, we are buying and selling cars. We pay salaries. We have people in the company employed. You can take your own company. Where do you work, please? Hello? Please, where do you work? Get close to your device. I want to respond to your question.
Ghana Water.
Ghana Water, good.
Yes, please.
Ghana Water, every month they pay you, right?
Yes, please.
The activity that Ghana Water does is to produce water and sell them.
Yes.
So the volume of water that you can produce, let's say you do the production from where you work, let's assume so. The volume of water that you will produce and distribute to Ghana, whether it is 1 gallon or 2 gallons or 3 gallons, they still pay you the same monthly salary.
Yes.
All right.
Yes.
Okay, so in that instance, the costs of salaries and the activity we are assessing the cost against, the cost behave in a fixed way. It stays the same whether you even produce water or you don't produce water. Okay. In the same vein, in this analysis, the people that we have employed in the car selling company, once they are employees and they are on payroll, and every month it's by law that they should be paid, whether there is a sale of car there or there is no sale of car, they get paid. So it's a fixed cost. It doesn't relate to the volume of the cars we sell. But the commission, the question made it explicit that the commission is paid only when a car is sold. And the commission per one car sold is 600. So you see that the selling of the car, that is the activity, and the commission, the cost of paying commission. More cars sold, more commissions will be paid. Less cars sold, less commission. So they vary in relation to the business, to the activity. That's how you do the assessment. So don't look at it from like this is universally fixed and so on and so forth. And I gave you the warning that from experienced teaching students, that's the mistake most of them do. They assess variability or otherwise of a cost against nothing. They assess it in space. And you are most likely not to understand even yourself. And the likelihood that you will get the assessment wrong is high. Okay. Thank you very much. I hope you are okay. Yeah, so let's proceed.
Yes, please. Yes, please.
Yeah, thank you. So we have our variable cost per unit as 24,000, selling price per unit as 27,000, and total fixed cost as 129,200. And these are the things we need to do the assessment. So break even quantity, I am writing it as this. You can also write it as this, but it will be more reasonable if you are doing this kind of thing to define your terms. Okay, BEQ is equal to break even quantity. Then subsequently, you have defined the variables. So subsequently, everybody understands what these things mean. What I mean is that you can use something other than this, but it should be defined from the beginning so that when you subsequently use them, everybody knows that this is what you call this. Okay. So break-even quantity is equal to total fixed cost divided by contribution per unit. Sorry. And this is equal to 129,200 divided by 27,000 minus 24,000 equal to 129,200 divided by 3,000 is equal to, give me this figure,
43.06.
43.06, which is approximately 43 cars. We can't have a fraction of a car. That may be maybe the bonnet or the bumper, but it's a complete car, so approximately 43 cars. 43 cars must be sold. And given the cost structure, Frankfurt Motors can pay all of its costs, but there will be nothing left. Break even. So when you go to the notes that we are doing this kind of thing from, you will see that the solution to it is somehow wrong. Okay, because when you give this job to the TAs to type, they kind of mistype them. So that's why it is also important to be in class. You can't just have the materials. So a few things are wrong, and the right solution has been provided here. So you can make the changes when I give you these notes. Yeah. Any questions? Okay, so we can proceed.
So finally, the answer is
43 cars. Of course, 43 cars.
Okay. Then, sir, let me also ask, what about the percentage of tax, that 25% tax that was said?
We are dealing with the issue step by step. We have not talked about it yet. So when it gets to the time to talk about it, I'll do so.
Thank you.
Now the next part of the question, B, is asking, what is the total sales revenue that must be generated by Frankfurt at the break-even quantity? Now we know the physical quantities in cars. that Francos need to sell. That one comes with what revenue? So it's a very basic question. Once you know the quantity of cars to sell, if you multiply it by the selling price per car, you can get the total revenue involved. Alright, so let's do that. The B question. B is saying revenue or break-even revenue. Break-even revenue. You can compute it in a very direct way. But when I finish with that one, I'll teach you a formula. And we are most interested in that formula, because that formula is quite useful when we are doing multiple product assessment. But basically, in a more basic form, you can get a revenue, the break-even revenue, by multiplying the break-even quantity by the selling price per unit, which is 43 cars times 27 cities. What would that give us?
1161,000.
1161,000. So this is it. Then to derive this same thing uses the concept of contribution margin ratio. Contribution margin ratio is equal to contribution or contribution per unit divided by selling price per unit. This is contribution margin ratio. The margin here, this term is actually an American term, the contribution margin ratio. The British also call it contribution to sales ratio. So in your reading, whether you come to contribution to sales ratio, contribution to sales ratio makes it even more explanatory. It's just a ratio between the contribution and the sales. So contribution per unit divided by selling price per unit. The Americans call it contribution margin ratio. It's the same thing, just a difference in terminology. It's the same thing. So for this particular question we are solving, contribution margin ratio or contribution to sales ratio is equal to 3,000, because we had our unit contribution to 3,000, divided by selling price per unit of 27,000, which will give us, what will this give us? 3,000 divided by 27,000.
0.111.
111.
Yes, sir.
It's just 111, or we have some other figures following. 111. Okay. So 0.111 cities. This is the contribution to sales ratio. When we divide, if you want to get the break-even revenue straight away, without breaking it into break-even quantity and then the selling price per unit, you want to get it straight away, you get it by the formula break-even revenue. It is gotten through this formula: total fixed cost, as you know already, divided by the contribution to sales ratio or the contribution margin ratio. So it would have been this 129,200 straight away divided by 0.111. If there is any difference between the 1161,000 as we calculated, then it will be as a result of rounding, because we even rounded the 43.06 to 43. Okay, when we were doing multiplying this 43 by 27,000. This one was a rounded figure. But if you are doing the same thing using the contribution margin approach, there is no rounding, because we are doing the 129, the total fixed cost, straight away by the contribution margin. So there will be a slight difference. But you can confirm, you can go back and use the 43.06 straight without any rounding. You will have to get the same figures. So let's see what this gives us. 129,200 divided by 0.111.
Gives us 116291.
116291. 6291. Is that all? Is that all?
A minute.
Please, I'm listening to you. Is that all?
No, it's
116.
Calculator yourself. Count 2 points.
6.
639.
639.
63.
33.
63.
No, 63.
63.
Yes.
1, 2, 3.
1163.
Yeah.
Good. So this difference, you see a difference. The difference is because this one is not using any rounding. It's using all the figures. But the other one, we rounded it from 43 point something. So let's do that one.
Yeah.
That was 43.06. Was that the case? The original, yeah, 43.06. Please, the 129,200 divided by 3,000. Was it exactly 43.06, or we have some figures following?
It was exactly
0.6. 06.
0.6, 0. What?
No, it's 43.0666.
066. How many six
Yes.
follows?
More than
about 6, and then the 7 after the 6.
Okay, so this is what I want you to do. Multiply that figure you have gotten on your calculator, right?
Okay.
Don't delete it. Just press your times. That value times 27,000. You will have to get the same as when we used this approach. Confirm that for us.
So you get 116.
You get
800.
Yeah. 1162,800.
1162,800.
43.0666. Just the figures you will get on your calculator. Don't change anything about it. When you do 129,200 divided by 3,000, press equal to. Let me use my calculator to do. So
what's this? Times 27,000.
okay, so this is we are
11,62,800.
doing this one 129 200
Yeah, by
divided
3,000.
by 3, 1, 2, 3. Okay.
Yeah.
This is the figure. This figure times 27.
27,000.
27. 1, 2, 3. 27,000 is equal to 1162,800.
800. Yes.
Okay. Then I asked you this question. When you did the contribution to sales ratio, contribution of 3,000 divided by selling price of 27,000, did you get exactly 0.111, or some figures were following?
Oh, that's 11111.
So that's where you made a mistake. You just told me it's just 1 up to 3.
No.
So now let's do it. This one is. Let me write it here. I just want to demonstrate to you how the two approaches are the same. So this one is given as 1162,800.
800.
Okay. Now I'm going to do the same thing again with the other approach. So it's going to be the contribution to sales ratio will be 3,000.
3,000.
1, 2, 3 divided by 27,000. 27.
Yes. So you will get the figure.
1, 2, 3. So this will give me 0.1111, a lot of ones, times. No, it's not times. Divided, some figure divided by this. Let me see.
Yes, by this. 129,200 divided by this.
129,200 divided by this. I don't know
And
how I
it will
can
give
make
you
it.
1,62800.
It will give you the same figure, right?
Yes, sir.
It will give you exactly the same figure.
Yes.
So when I do, how many ones here? Let me see if I can even copy this. I just want to confirm for everybody to see on screen. Sometimes when I ask you to calculate, you miscalculate for me. So now I'm doing 1, 2, 9.
That's the mistake. It's 9. Yeah.
1,
1
2,
to 9.
9, 200
200.
divided by. Oh, I think I had some figures already there. Let me clear everything. Clear everything. Okay. So 129,200. Okay. Divided by.
There is 2,000.
Divided by.
They go back is
Divided.
2,000.
It's 2,000.
Yes.
The one that you filed.
Yeah.
200, not 2,000.
1, 2, 9,
9.
200.
200.
Good. Okay. Divided
Yes.
by this chain of numbers, right?
Yes.
Equal to 1,162,800. So they give you the same thing. If in exams, because you rounded some figures, blah blah, those rounding difference are seen to be insignificant, and then you will be right. So you just have to get the understanding that the two approaches give you the same thing. Any difference will just be whether you have rounded some figures or not. But you need to really take this one into your head, the concept of contribution to sales ratio. So break-even revenue is equal to the total fixed cost divided by contribution to sales ratio. Yeah, this one gives you the revenue at the break-even straight, even though you can also do the quantity times the selling price per unit. Let's go to the third requirement of the question. Frankfurt Motors has a target monthly net income of 51,000. What is its target monthly operating income? This question, I'll break it, I'll modify it because it's a little bit tortuous, and for the beginning, I'll want to take it step by step. So let's make it this way. What if Frankfurt Motors wants to get a target or targeted operating profit? Operating profit is the same as profits before interest and tax. If Frankfurt Motors wants to get a targeted operating profit of 51,000. So I'm modifying the question.
Can say again.
If Frankfurt Motors has a targeted monthly operating income of 51,000, what should be the quantity of cars that should be sold to earn that target operating income? Let's answer that question first.
What should be
the quantity of cars that should be sold to earn that targeted operating income? Are you okay?
Yes, sir.
Okay. So let me give a brief lecture on that. Operating profit is profit before we give the tax to the government, before government comes to take his portion in the form of taxation. So it has nothing to do with tax. So Rosemary was asking about the 25% tax. It means that following from that analysis, it will not be that the government will never tax, the government will always come to tax. So we have to look at the situation if the government comes to take from our income, our profit. What should we sell to earn some target profit after the government has come to tax? So that is when the tax comes in. But the first one is where tax doesn't come in. That's why I'm modifying the question. So we are solving the modified question. Let's go back to the drawing board. Sorry. So profits quantity of cars to sell to earn a before tax profit of 51,000 Ghana cedis. So in terms of notation, you can say quantity to earn profits before tax, PBT, equal to 51,000. This is how I will write it. You can write it in some other way that makes sense. I want to write it in such a way that if everybody sees this and the person has some knowledge of what we are doing, he will see exactly what I'm doing. So I'll say this is the notation. It's equal to, the formula is, you know the formula. Let's go back to the genesis of our formula. This was the generic formula. And we said that when we are assessing the zero profit situation, put 0 here. Now we are assessing some target profit situation. Put that profit here, 51,000. Sorry. 51,000. Put it here. And then it holds. So that's what we are going to do. So it will be equal to the total fixed cost plus the target profit. Let's make it TP, target profit. If it were the break even, we would have put 0 here, but this is a target profit. Let me be specific because we have the figures already. Plus 51,000. That's the target profit. 51,000. All divided by the contribution per unit. Contribution per unit So when we do everything completely, we will have 129,200 plus 51,000 all divided by the contribution per unit was 3,000, right? Please, I want you to follow. Involve yourself in the discussion.
Yes, sir.
Okay.
Yes, sir.
So this will result in 129,200 plus 51,000. What would that be? Let's simplify. Evaluate the top.
180,200.
180. Like this.
200. Yes.
Okay. Divided by 3,000. So this will be what? This will give us
60.06.
60.06.
Yes, please.
Which is approximately 60 cars. So for Franco Motors to go beyond the zero profit to now target 51,000 cedis a month profit, he needs to sell more than the initial 43 that made him broke even. to 60 cars to be able to earn a supernormal profit of 51,000 before tax. Any questions? Any questions? Okay, let's proceed. So this is an assessment where the company wants to get a target profit before tax. Tax has not come in. Now let me ask, if that 51,000, if we want to get the same 51,000, but after government has come to take his tax, what do you think will happen to the number of cars we have to sell? I want you to do that kind of mental exercise. These 60 cars, that's what we have to sell to earn a profit before government comes to tax of 51,000. How many cars, or what will the volume of cars that we have to sell be if we want to get the same 51,000 profit, but after government has come to tax? Will it be the same 60 cars? Will it be less than 60 cars? Or will it be more than 60 cars?
It should be more.
Exactly. It will be more than 50
More
cars.
than.
Sure. So that is the tentative idea you have to build. Now we are now going to look at how the formula will be like if the government should come in now. But you have to be very much conversant with this one without the tax, because it is just that one we are going to modify with a tax. Okay. Just focus. It's not difficult. Just focus. This 51,000. This profit before tax of 51,000. All right. If the government, let's say tax rate, the tax rate was 25%. If the government takes his tax of 25% from this, then we will be left with what is called profit after tax. Let's call it PAT, profit after tax. So normally, if you look at the whole analysis, this is the equation that links them. Profits after tax is equal to the profit before tax times tax rate let me write it well. Profits before tax times tax rate subtracted from profits before tax. Let's use this to demonstrate this expression, and you'll see that it is not difficult to understand. Let's use this one as let me use different figures so that you don't get confused with what we have done. This is, let's say, some profit before tax figure was 10,000. Profit at 20, tax at 25%. So what will be the tax amount? The tax that we have to pay to the government?
1,000 minus.
No, this is the tax rate, 25%. This is the profit before tax. What will be the tax amount?
2,500.
2,500.
Yes.
Explain how you got it for the sake of those of us who don't understand.
It's just 25% of the 10.
Exactly. So you multiply 25% by the 10,000. So this is the amount we have to pay to the tax. It's to the tax officials. When we pay this tax, what will be the profit after tax?
Yeah, 7,500.
It will be equal to 10,000 minus 2,500, isn't it?
Yes, please.
Yes. So you realize that PAT, profit after tax, is equal to profit before tax minus this one. This one is profit before tax times tax rate. Isn't that what you did?
Yes, please.
The tax amount of 2,500, you got it by multiplying the profit before tax of 10,000 by the tax rate, isn't it?
Yes, please.
So when we come to say that profit after tax is equal to this profit before tax minus this 2,500, which is this, minus profit before tax times tax rate. That is correct mathematically. Is that correct? Are you okay?
Yes, sir.
Yeah. So we go ahead and say PAT is equal to, now you can see that we have PBT here. So we can say this is equal to PBT out 1 minus tax rate. When we expand this, the one I've just written, we'll get this one. PBT times 1 gives us PBT minus PBT times tax rate gives us PBT times tax rate. So it's the same. Are you okay with that? Please, are you okay? Hey, you are not minding me.
Oh, maybe I will do.
So we are okay.
Good. So we will now realize that PBT part can be expressed as a function of PBT in this form. Part is equal to PBT times this. We can even express the PBT also in terms of PAT. So we have PBT, if you want to make PBT the subject, we have PBT is equal to the PAT divided by 1 minus tax rate. What it means is that if we are given profit after tax figure, we want to earn a profit after tax figure of this much. That profit after tax figure can be converted to profit before tax figure using this formula. The reason is that you already know how to calculate for this without the tax. It is as straightforward as total fixed cost plus the PBT, profit before tax. When you have to do for where the tax comes in, it comes to complicate it. But if you can convert the profit after tax into profit before tax, then the formula is the same as this. And to convert the profit after tax to profit before tax is to divide the profit after tax by 1 minus the tax rate. It goes back to the profit before tax. For example, the 10,000 example we use, the profit after tax was 10,000 minus 2,500. What would that be? 10,000 minus 2,500.
It's 7,500.
7,500. This is the part. If I convert this part to PBT, I'll come back to the same 10,000. So PBT is equal to this 7,500 divided by 1 minus 0.25. 25% is 0.25. So divide 7,500 divided by 1 minus 0.25 will give us what? 0. Is it 0.75?
Yes, please.
Okay, so divide 7,500 by 0.75.
That's 1,000. No,
Please.
10,000. Sorry.
10,000.
1,000.
Yes, and this 10,000, have you realized, is the same as our profit before tax?
Yes.
Okay, so that you have to be very noteful of this formula. So we have converted the PAT into PBT. So we can forget about the tax, bringing in the rate and other thing into the complication by first of all converting the PAT into PBT. And then the formula becomes the same as what we know already. If you want to infuse the tax thing into it, then the whole thing becomes maybe quantity to produce and sell to earn a part, some targeted profit, will be equal to the total fixed cost plus this target profit part divided by 1 minus tax rate. Actually, this is a converted, this whole expression is a converted part to PBT, as I have demonstrated here, all divided by contribution per unit. So you can single this one out if that is comfortable for you, but through what we have done here. So let's say the question gave me after tax profit of 7,500, that's what the company wants to earn. I would have converted this 7,500 to the equivalent profit before tax, so I will use this 10,000. And then this formula needs to show the conversion because the marker will look at all these things. Or you can do it straightforward through the formula. In that case, I'm using the generic example. It will be, we don't know our total fixed profit. We'll come back to the question itself. I just want to demonstrate. Total fixed cost plus the 7,500 divided by 1 minus 0.25, which is the same as all the things we have done here so far, these things. All divided by the contribution per unit. But if you had singled this one out to compute to get this 10,000, this working will be there. So you could have slotted the 10,000 straight here as well. That's what I'm trying to say. So let's go back to our question. Our total fixed cost, so quantity. Now let's go back to the question because I modified the question. So let's phrase another question which says, Frankfurt Motors has a targeted net income is the same as profit after tax. Net income, in this sense, is the same as profit after tax. So let's make it specific as we are learning. Frankfurt Motors has a targeted monthly profit after tax of 51,000. What quantities of car must be sold to earn that targeted profit after tax? Please, have you put that question down?
Sir, please repeat it. Please repeat that side.
Frankfurt Motors is. It will be good you put it down because I am deviating from exactly what I've typed here, and I'm doing that for your understanding. So put those modifications down so that as you are revising, you will not be confused. So the question I'm reading is Frankfurt Motors has a targeted monthly profit after tax of 51,000. Profit after tax is the same as net income. Frankfurt Motors has a target monthly profit after tax of 51,000. How many cars should Frankfurt Motors sell to earn that targeted profit after tax? Can I proceed?
Yes,
Yes,
sir.
sir.
Okay. So we have done the explanation of how the formula will be like when the tax then comes in. Now what we have is that the target profit, the targeted profit after tax is equal to 51,000. Our formula will be equal to 129,200 fixed cost plus the targeted part 51,000 divided by 1 minus 0.25 all divided by unit contribution of 3,000.
So excuse me.
Yes, sir.
The Q part is the Q part equal to 51,000. What you are putting now? The formula you are putting now is for the 129,200 plus the tax 1 minus 0.25 by 3,000. That formula is for what?
Who can help him for me? That formula is for this thing. And I've been talking all along. Yeah.
Yeah, I've seen it, but because I saw equal to 51,000, so that's how I was a little confused. Thank you, sir.
Okay, and you shouldn't be confused why I wrote the 51,000 here, because that's what the question is. Question says what volume should be produced and sold if the company wants to get a target profit after tax of 51,000.
Okay.
So the part is 51,000. I'm trying to get where the confusion is coming from. You know, when we do the PBT was also 51,000. That shouldn't be. It's the same figures we are using, but this 51,000, we want to get it after government has been taxed. The government tax has been paid to him. Okay, so don't be confused, please. Okay, so now it becomes 129,200 plus, when you reduce this, what will this be? 51,000 divided by 0.75. This one, when you evaluate this one converts the part to PBT. That will become what?
6,000. 68,000.
68. Someone should confirm for me. 51,000 divided by 1 minus. In other words, 51,000 divided by 0.75. Confirm that it is 68,000 for me. Confirmed?
Yes, confirmed.
Good. Divided by 3,000. Then let's evaluate the top. 129,200 plus 68,000.
197,200.
197,200. This plus this. Okay, 197,200. Is that correct? Someone should confirm.
Yes, sir.
Confirmed.
Divided by 3,000. So what would the final figure be?
65.75.
65.7. So approximately 66 cars. So it confirms our initial evaluation that if we have to get the same profit after we have paid the government, then we need to sell more cars. The one that we did not have to pay the government, we had to sell 60 cars, if you remember. 60 cars.
Yes, we do.
60 cars. See, now we want to get the same profit, 51,000. But after paying government tax, it means we have to sell more cars. At least we have to sell cars that will bring the difference that we have to pay to the government. And it is additional cars, additional 6 cars. So we have to go for 66 cars. Any questions?
Sir, please, the percentage is 0.75 or 0.25.
The tax rate is 0.25. The formula is 1 minus the tax rate. When you do 1 minus 0.25, which is the tax rate, you get 0.75.
Thank you, sir.
Are you okay? Okay. Any questions?
Hello, sir.
Any other questions? Yes, please, let me know your question.
Yes, so you realize that we, instead of putting the formula, using the formula of profit after tax
Yeah.
in calculating, if you charge the 25% of that on the targeted profit and add it to the fixed cost, I think you arrive at the same answer. So in that case, when you do it that way, would you be penalized for that?
Why should he be penalized for doing the same thing in a different way? There's no penalty. The only
No,
penalty will be
because
where
you said the examiner will be interested in the formula.
it shouldn't be so. I can't think for all examiners, but examiners should be very flexible in their perspectives. They should be expecting that there are different ways of doing the same thing, and students might have read from other sources that give varieties of approaches. That's what I think. All right, you look at the reasonableness between the students and behind the students' presentation. If it makes sense, this is simple mathematics. All right, so that's not the point. But one thing you have to know is this: by coincidence, your final figure could be the same as what should have been the right thing, but your approach was wrong. In that case, you'll get everything wrong, because if your approach is wrong, no matter whether by coincidence you had the final answer to be right, everything will be marked wrong. I'm saying this because some students happen to, at least as if they are magicians, the approach and everything they are doing is wrong, but they manage to get the final answer to be correct. Mostly the reason behind it is that they themselves don't understand what they are doing, but they manage to giraffe and pick someone's answer, and the final answer happens to be right. Yeah, that's not what you are saying. You are saying a different approach. Me myself, I gave you two approaches. I told you that this figure here, or this expression here, can be evaluated outside of the main calculations, and then the evaluated figure slotted here. I told you this is a formula that converts parts into its equivalent PBT. So if you had done 51,000 divided by 1 minus 0, like trying to convert the parts into PBT, okay, I'm converting the part into PBT, and this is the formula. So once I do this somewhere and get the figure, you had 68,000. I could have written the formula as 129,200 plus 68,000, because I have done this one separately somewhere, and the workings are in my book. That is what you can do. That is acceptable. And I don't exactly understand what you said. When you charge what and add what? All I'm trying to say is that make sure the approach is mathematically correct. If it is so, you will be marked right. At least by me, that's what I think. There is no penalty for you using an alternative correct approach. No, that's not what we are saying. If you can do that, that should be encouraged. Students should be encouraged to learn wide. So if you have been able to learn other ways of doing it and you are exhibiting it, why should you be penalized for that? But if it is a wrong approach, then that wrong is wrong. That's it. Any other question? No other question. Okay. How many hours have I taught? Please, I'm asking a question. How many hours have I taught?
About 3 hours.
3 hours.
3 hours.
3 hours.
Yes.
Can we give ourselves a brief break? And how many minutes will that be? Brief break.
15 minutes.
15 minutes, okay.
Let
So
me-
between
So that's 10:30 if we set it.
10,
10:30 we
10,
start.
yeah, between 10 and 15 minutes. Okay. So let's pause, go for a small break, and then we come and conclude. Okay, so welcome back. So far, we've been able to look at the whole concept of cost volume profit analysis. Before tackling cost volume profit analysis itself, we looked back, visiting some concepts in marginal costing, on which we will build our understanding of CVP on. We have done all of those things. We have looked at cost volume profit analysis in single product environment. Most specifically, we have assessed the break-even position of the organization. We have assessed where the company wants to earn some target profit before tax and profit after tax. We have looked at, in fact, we went through the derivation of all the formulas. We did not just quote the formulas, because our solid understanding of the concepts depends on we understanding why a certain formula is the way it is, and not just chewing the formula and applying it. We have done all of those things. So before, what is left for me to talk about in the single product environment is the concept of margin of safety. And then I have to conclude that analysis with how we do break-even chart. I'll do the chart with spreadsheets, but I may not do it today because if I should open, that is what caused my machine to crash yesterday. If I should open the spreadsheet application, I'm just adding a load. The memory, I'm using a memory of 6 gigabytes, and I'm running a lot of applications, so they are all using up the 6. If I should open the Excel application along the line, my machine will crash. I may even lose the recordings I'm doing. So maybe I'll shift the spreadsheet modeling and anything spreadsheet modeling to a different lecture. I mean, maybe a lecture exclusively on that, about maybe 30 minutes, maximum 1 hour to do those things. Yeah, so I'm going to talk about the margin of safety briefly, just a small concept. Then we begin the multiple product environment assessment. Any questions before we start the game? Any questions? Okay. That also means that if you want to, teachers, we don't have money. If you want to donate to me to get a high-tech machine that can, because my machine is not a modern machine. I'm just trying to improvise. That is also welcome. So margin of safety. Sorry. Margin of safety. In fact, the main thing here is the word safety. What's the meaning of safety? I want us to understand it from English, from language perspective, before we bring in the technicalities about accounting. Safety. What does it mean? Safety. And margin
Free
of
from
safety.
danger.
Okay, thank you very much. Free from danger, away from danger. Okay. So margin of safety, what would you say? What would you say? Margin of safety. Nobody is talking.
Hello, sir.
Yes, sir.
So a range within which one is free from danger.
Okay, thank you very much. Have you heard of the expression margin of error before? Margin of error.
Yes, sir.
Okay. What did it mean to you, margin of error?
That is the acceptable
Yes, it means
amount
the level of error which is acceptable.
acceptable.
Good. So level. We can also use this expression as a substitute expression. Distance. Okay, the distance of the error. We know this is the what we want, but we can deviate. But when we deviate by this distance, we will take it as that it is good. So margin is something like a distance or level, as you have said. So margin of safety, the distance of safety. He said being away from danger. So what is the distance between the safety place and the danger? Or the safe place and the danger? What's the distance? What's the level? That's what the margin of safety tries to measure. And in connection with what we are doing, margin of safety means this. You know, if, let me draw this line. Something like a number line, right? This is the point of origin, 0. The whole of this region is, let's say, positive, right? Positive region, and this is negative region. Is that correct? And then we can have, let's say, 1, 2, 3, 4, 5. Negative 1, negative 2, negative 3, negative 4, and so on and so forth. This is the break-even situation, the origin. We have neither profits nor loss. But who want to be in this region? Who want to be here? And what does being in this region mean? You can tell me your name so I call you to respond.
It's Peter.
Yeah, Peter.
Yeah, that is meaning you are running at a loss, and it's very dangerous. When in the business, running at a loss all the time.
Okay, so would you want to be in that region?
No, sir.
Yeah. Who wants to be at this region or in this region? Everybody. So this is the positive region. This is where you start making loss. You start making profit. Good. So this one, sorry. This one becomes like the boundary, the border, beyond which you go to the unsafe place. No safety for you. It's like beyond this border, you fall into the pit and you can die. So you always, if very possible, you want to be very far away from this line. Isn't it true? When you are on the line, you have not fallen into the pit yet. But would you see yourself to be safer being just on the line?
No.
Yeah. If you have things your way, you will wish to be very distant. Very, very, very distant from even the origin. So we assess a company's margin of safety, margin from the danger, distance from the danger of running into losses and possibly collapsing by looking at how much the business has sold and how much it needs to break even. So if your sales is very wider from the break-even sales, then you say your margin of safety is wide. In fact, you are in a good position. You are safe. If your sales are very close to the break-even sales, then it's like this is what is happening to you. You are like moving. Let's say year on year your sales keep dropping. Then it's like you are moving. You are coming. 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 You can come and be on the line and even go past the line and be in this region, which is quite dangerous. So simply, the margin of safety measures how wide you are from the break-even. The break-even is the border. The border of death and life. So how wide you are from the border of death and life is your margin of safety. So it is calculated simply as your break-even point, your break-even quantity. We can use the quantities to calculate it. We can use the sales revenue to calculate it. We can even compute it as a percentage of the sales. So let me just go and read a few things I captured in the notes for you. That will be quite straightforward, and we are done. Margin of safety. I've given you the overview. That's quite simple for you to understand everything that follows. Margin of safety is the extent that sales must decrease before losses are recorded. In other words, you can also put it in the same way I said it. Margin of safety is how wide you are from the danger of running into losses. It's a measure of how wide or how close you are. That's your margin of safety. So your margin of safety can be very narrow, it can be wide, it can be good, it can be bad. It specifies the extent of vulnerability of profit to changes in sales. In other words, it is the region that is safe for an organization to operate. And of course, it's not just a region. We are trying to get the rate or the extent at which you are safe. Within that region, fixed cost has been covered. Therefore, all production will lead to profit. It is determined as, so this is what my interest is, the way to calculate it. As for the understanding, it's there already. It is determined as the difference between, so if you are using budgeted figures, the difference between the budgeted or the expected sales and the break-even sales. Normally, these analyses we are doing, we do them more on budgeted basis. It's for planning purpose. They are planning tools. So I want to embark on a business. I want to know how profitable the business will do. In addition to doing budgeting or what we call investment appraisal to know how viable the business will be, and we also want to employ some of these tools to assess, okay, how many products would I have to even produce and sell to break even? If I want this profit in this period, how much we can add these kind of analysis to our appraisals, and it will be better than if we don't do it. All right, so they are mostly done on budgeted basis. The business is not yet done, or if the business is even established, we forecast ahead of time, so they are employed more for future things yet to come. So the margin of safety will be what we have budgeted to sell and what the budgeted break-even sales is. If the gap between them is wide, then our margin of safety is quite good. If it is very narrowed, it means if there is something we can do, we have to do. If the margin of safety is negative, which means we are in the loss region. That is quite very bad. It means you have to look at things before you even go ahead and do that business. Margin of safety can be expressed as an absolute value or as a percentage of the budgeted sales. So we can just do our target sales or budgeted sales minus the break-even sales, just like that. We can use the quantities to do that. We can use the sales revenue to do that. In other words, we will get the margin of safety in revenue terms. We can also compute it as a percentage of the budgeted sales. In that case, it will be the budgeted sales minus the break-even sales divided by the budgeted sales times 100%. Right, so that is all to know about it. So let's try to see whether from the Frankfurt Motors we have full information for us to compute. Yes, we can. We have computed the break-even cars for Frankfurt Motors. Let's use the basic one. It was 43 cars. So if in a month, Frankfurt Motors can sell 50 cars, then the margin of safety is the 50 cars that it can sell minus the cars that it has to sell to break even. So 50 minus 43, which will give us 7. So that's the margin of safety. 7 cars. No, don't write just 7 cars. You can also use the revenues involved. The revenues that come with 50 cars, 50 times 27,000, minus the revenue at the break-even, 43 times 27,000. Then the break-even will be that difference.
Hello, sir.
Yes, madam.
We can see the calculation.
Can you see my screen?
Yes.
I'm actually not calculating, I'm reading. You want me to calculate, right?
Yes.
In fact, this is a basic concept. When you go home, you yourself, you can calculate everything by yourself. You still want me to calculate? Let me give this small calculation to you as an assignment, all right? Once you get the understanding, when you go home, you can calculate.
Okay.
Yeah. So that is the margin of safety. Sales, budgeted sales. The question will give you what the company budgets to sell. That will be different from the sales that the company should do to break even. So what the company budgets to sell minus the break even sales is your margin of safety. When you are using the quantities, the budgeted sales in quantities minus the break even sales in quantities, you get a margin of safety in quantities. So with respect to the Frankfurt case, that will be in cars. So if it is 50 minus 43, that will be 7 cars. And I'm also saying that you can use the revenues linked with these points to also do it. So target sales revenue, break-even sales revenue. The difference gives you your margin of safety in revenue. You can also compute the the margin of safety as a percentage of the target sales. In that case, the target sales minus the break-even sales divided by the target sales again times 100%. So you get a margin of safety as a percentage of. In other words, your conclusion will be that, okay, my revenue needs to fall if you are using the revenue, or if you are using the physical quantities. My sales in physical quantities need to fall by this percentage before I run into the danger of making losses. It's a measure of safety. Okay, so let me give you that assignment. After the lecture, you can do Google margin of safety calculations. You get some nice materials on the web. Go through it with the understanding we have built so far. Solve any questions that you will find from your search. You will be very fine. Okay, now we are done with CVP analysis, single products, except using spreadsheets to do some modeling on this. And I've told you I'm going to shift that to a different lecture, because if I should run my Excel right now, my machine will run into it will just shut down because of memory shortage. So let's move straight to cost volume profit analysis, multiple products. And I've as well shared this information. It's already on your platform. I told you the sandwich student took the same course, so all the materials you need are already there. It's already there. Break-even analysis, multiple products, is quite the same as a single product, except that now 2 or more products are involved. We do not do the analysis by looking at each individual product and then summing the results. No, we have to jointly do it. And there is no easy way of doing it jointly, except by making some key assumption. The key assumption is that the products, the multiple products we are dealing with, they are sold in some fixed ratio. They are sold in some fixed ratio. So it works like, it doesn't make so much logic, but we can have a way it works somehow like the assumption in practice. So it works like, let me use an example. Let's say Coca-Cola company or Guinness Ghana. Guinness Ghana produces the Guinness beverage. It produces Origin. It produces Alvaro and others. A lot of products. It produces and sells them. So the key assumption is that these products, Guinness, Origin, Alvaro, let's say they deal with these three. These three are sold in some fixed proportion. So it works like anytime a customer goes to a sales point, he cannot buy only Guinness and go. When he buys Guinness, he has to buy Alvaro and also buy Origin. And the number they will buy of each of the products follows some fixed proportion. So it may be like 1 bottle of Guinness is associated with 2 bottles of, maybe 1 bottle of Origin and 2 bottles of Alvaro, for example. That's what the assumption is like. On the face of the assumption, there is not much sense. But this is how it may apply in reality. You see, in reality, some companies sell on promotional basis, something like buy one get one free. Okay, so it works around that way that we naturally can sell. So it's like, okay, we are selling in packages. We are selling in packages. So when you come to a sales point, we have put the items in a bag. If you are coming to buy Guinness, buy 1 Guinness, or let's say buy 2 bottles of Guinness, get 1 Origin and 2 Alvaro bottles free. So it's packaged. That is how this assumption can be linked to. Otherwise, in reality, naturally, the way we sell, that assumption it doesn't make so much sense. That the multiple products I sell them in some fixed ratio. So it's like nobody comes to buy a single. You have to buy this and this and this in some fixed proportion. Unless you are doing a promotional sales where the things are packaged. Apart from that promotional package, another way we may see this assumption to be likely working is that, not likely working, when we have sold our goods, let's say in a period, we can come up with a number of bottles of Guinness sold, number of bottles of Alvaro sold, number of bottles of Origin sold. So they are there individually. We now can do the mathematics in terms of the ratio between them. Okay, given this volume of Guinness sold and this volume of Alvaro and this, the ratio is that every 2 bottles of Guinness sold, there was 1 Origin bottle sold and 2 Alvaro bottles sold. That one can be computed. Okay, so that may be the main sense, other than the fact that when people are going to buy, we have to make them buy what they have not planned to buy. Okay, so that is the assumption. We sell the products in some fixed ratio, some fixed proportion. That is called the sales mix. The proportion in which the products are sold is called the sales mix. I'll give you, like I told you already, this information is there, so when you read, you will understand what I'm saying. Right. So let's go straight to the point. When we are computing the break-even quantities, the logic is the same as what we have already learned, except that we should be guided by the assumption of sales mix, constant sales mix, some proportion of sales between the products. We can approach it in 2 ways. We can design a methodology that makes everything about the multiple products appear like the single product environment, because we are comfortable with that one. So we'll look at that one first, where we try to think around the issues and try to make things the same as what we know already, like we are dealing with single product. And then we'll come to where we open things up, we are dealing with multiple products and the formulas that are involved. And the beautiful thing is that the formulas are not quite different from what we know already. It's just massaging them in few ways. So just get that comfort and bring your focus here. First approach, if based on the assumption, what we are doing is like selling the product in packages. Let's say we sell we sell Alvaro, we sell Guinness, we sell Origin. But this is how we sell them. We have boxes or we have bags that we put the 3 products in. And then bag them. Tie the bag or box everything. So let me draw something to illustrate. So I'm trying to draw something like a bottle. So this is Guinness. This is Origin. This is Alvaro. We have 3 products. Okay, but what if I do this? Put them in a bag. When they are in the bag, do you still see 3 products or you see 1 bag?
You see 1 bag.
Yeah. So when we put them in a box or we put them in a bag or a basket, the basket becomes a single product. It's like we are selling baskets. But inside the basket, we have these hidden 3 products. So we can go about it in that way where we put them in a basket and it's like we are selling baskets and it's one basket. So it's one product. So we will first compute the number of baskets to break even. When we get a number of baskets to break even, then we'll go and open every basket and sort the individual products. Then we can know, okay, this is the number of products of this, number of units of this product, number of units of that product, and number of units of that product. So first of all, you try to force to see it as a single product, baskets. We are selling baskets. When we get a number of baskets, then we can open every basket and get the products involved. Is that okay?
Yes, sir.
Yeah, so that is one approach you can go with. So let's proceed with that approach. Let's take an example in your question. In the notes. This example. A company sells 3 products. XU, YU, and ZU. Cost and sales data for one period are as follows. So we have for XU, YU, and ZU, sales volume in units, they are there. 2,000 for XU, 2,000 for YU, and 5,000 for ZU. Sales price per unit or selling price per unit for the 3 products are also there. 3, 4, 2 for XU, YU, ZU respectively. And then variable costs per unit are also given. 2.25, 3.50, 1.25 for XU, YU, and ZU respectively. Fixed cost for the whole period, for the whole of the organization, is 3,250. Determine the sales mix for the 3 products. So, like I told you, when you have all the sales made for the 3 products, if you have the data with you, you can now strike the ratio between them, and that becomes like the sales mix. So we have 2 to 5. So if you compute a ratio of 2,000, 2,500, compute a ratio between these figures, that becomes the sales mix. And we assume that that sales mix is constant, at least it is constant within a period. Alright, so you can compute it in absolute terms like this. So we have sales mix. We have XU, YU, ZU. So sales volume in units is 2,000, 2,000, 5,000. The ratio is just reducing these numbers to the barest minimum. Is 2 is to 2 is to 5. This may be the least that you can go. 2 is to 2 is to 5. You can bring a total column which will be 9. The total ratio is 9. Total ratio is 9. You can also do it in percentage. Percentage wise, total will be 100. So this is what percent of the total. Then it is, total here will also be, total in terms of the gross sales will be 2,000 plus 2,000 plus 5,000, which is 9,000. Is that correct? Please, are you following what I'm doing?
Yes, sir. You're following.
You're following, sir.
Okay. So total in terms of the volume of sales is 9,000. The ratio between these 3 figures is 2 is to 2 is to 5, giving us a total ratio of 9. We can also do the sales mix calculation in terms of percentages. So percentage wise, this total will be 100%. Then we find the percent of each of these things from the 100. In that case, it will be this 2000. You can do it with the reduced numbers, these ones, or you can do it with these ones. They will all give you the same figures. If you do with the gross figures, it will be 2000 divided by the total 9000 times 100%. So 2000 divided by 9000 times 100%. That will give us what? It's the same as, you can do it simply as 2/9 because the 3 zeros will cancel themselves. That's why I said you could have used the simple figures 2/9, 2/9, 5/9. So all the 2/9 times 100%.
22.22%.
22.22%. And this one will also be the same, 22 point, because it's the same figure, 0.22%. And this will be something else. What will this be? Let's calculate and put a figure there.
That'll be 55.55.
55.55. Okay. But the challenge with the percentage is that you realize that you need to do some rounding downs and rounding ups. Sometimes that may not be comfortable. When I round down here and round up here, it's like I'm shifting something from XU to YU. So I will not recommend percentages, especially where you don't get exact percentages. Then you can resort to using this one. 2:2:5. In percentages, they will be like this. No problem with the calculation, but I'm just worried with the roundings because they are not exact values. So this becomes the sales mix between the three products. 2:2:5. Total ratio is 9. So if you're asked to compute the sales mix, this is just how you do it. And also note that the computation of the sales mix can be done from two perspectives. From the physical sales, so this is sales volume in units. You can also do it from the revenue. So if they have reported the revenues, of course, in the question you can do that. We have selling price per unit. When you multiply it by the quantities, you get the sales revenues. So you can use the sales revenues to also compute the sales mix. So that will become the sales mix revenue-wise. But the two will not be the same, and they don't need to be the same. So it's not like if you compute the sales mix using the revenue, you have to get 2:2:5 like we have gotten for using the physical quantities. No. But the sales mix revenue-wise between them is also used when we are doing some other analysis. When we get there, I will draw your attention. So in the meantime, that's how you calculate the sales mix for the three products, 2:2:5. Now the second question is determine the weighted average contribution. Let's break it down. Weighted average contribution of the mix. So I think I need to skip this one first. Let me break it down small. Weighted average contribution. Before weighted average, let me approach the lecture step by step. Before weighted average, let's even do this. Contribution per mix. The mix is like the bag or the basket. Contribution per basket. Now, this is what we are doing. This is contribution. This is the ratio between them. No problem about that. But we are selling them in a package, as if we are putting them in a basket and selling the baskets. So for each basket, what is the contribution inside it? each basket will contain 2 XUs, 2 YUs, and 5 ZUs. That is the ratio through which we sell them. That's the proportion of sales between them. It's like in the basket, we put 2 XUs, 2 YUs, and 5 ZUs. And then we sell the basket. We are selling the basket. People come and buy the basket. But we need to know the contribution for each basket. The contribution for each basket is the contribution per mix. It's a contribution per mix. And the calculation is simple. When we open the basket, we see the individual products. So we have XU, YU, ZU. XU has selling price per unit. Sorry, all the product has selling price per unit. And all of them have variable costs per unit. So when we do this, let's go to the question. Selling price per unit 342. 342. Variable cost per unit 2.25, 3.50, 1.25. 2.25, 3.50, 1.25. Let me check if I'm correct. 225, 350. Yeah. So contribution for each of the products. Give it to me, please. For XU will be what? Hello?
Yeah, we are.
Is it 6.75?
5.25.
For which one?
That's you.
5 points. Are you sure? What is contribution? Hey.
Contribution is 0.75.
Hello, sir. Contribution is
selling price minus
the selling price per unit minus the variable cost per unit.
Good. So how come when you do this, someone is telling me 5
It's
point something?
0.75 for SU.
Okay, that's good. So you have to be watchful. It's not your 5. I don't know whether you multiply them. This one will be what? For YU, this is 4. 4 minus 3.50.
0.5.
0.50.
0.50. Good. 2 minus 1.25.
0.75.
75.
0.75. So the sum of the contributions of the 3 products will be the contribution for the basket, because inside the basket we have these individual contributions. So contribution for the basket, sum these ones for me.
It's 2.
It's 2. The sum is 2.
Yes, sir.
Oh, sorry. There is something we missed out. So this is the contribution, right? For each of the product, for 1 unit of XU, YU, and ZU. Then in the bag, so you have number of units in basket. In the basket, we have 2 of XUs, 2 of YUs, and 5 of ZUs. This is contribution for 1 unit of the product. But in the basket, we have 2 of XUs, 2 of YUs, and 5 of ZUs. So the contribution that XU is sending to the basket is the contribution for 1 times 2. This will give us what? 0.75 times 2.
1.5.
1.5. 0.5 times 2. 1. 0.75 times 5.
3.75.
3.75. Good. Now we can sum them. Now we know the contribution each of the product is sending to the baskets. XU is sending 1.50 because there are 2 XUs and each one is bringing a contribution of 0.5. YU is sending a contribution of 1 to the basket because there are 2 YUs in the basket and each unit is bringing 0.5. ZU is sending a contribution of 3.75 to the basket because there are 5 ZUs and each ZU is bringing a contribution of 0.75. Now let's sum them. What do we get?
6.25.
6.25. So this becomes the contribution per mix, or the contribution for the bag, or the basket, or the box, whatever one you want to use. Contribution per mix, but the standard term is contribution per mix. I just want you to understand that practical, that's why I'm using baskets and other things. Contribution per mix. So, like I was telling you, you cast your mind back when we're doing the single product environment. If you want to get break even, you divided your fixed cost divided by the contribution of that product. In the same vein, if you want to get break even baskets, it is fixed cost divided by the contribution of the baskets. Then we get break even basket. Remember, it is not break even the product, but break even baskets. And inside each basket, we have a number of products. Are you okay?
Yes, sir.
Okay. So we can go ahead and compute the break-even baskets. Break-even quantity in, let's say, baskets or whatever. That will give us total fixed cost, or you'll be giving us total fixed cost divided by contribution per basket or mix in this case. So if you go back to the question, our total fixed cost for the whole of the organization was 3250. 3250. And so this becomes 3250 divided by contribution for the basket is 6.25. That will give us the number of baskets that we have to sell. So what would this be? What would this be, please?
520.
520, sir.
520 watts. You can't leave it as 520.
Units.
Basket.
520 baskets. Good. 520 baskets. That is if you said you were selling in baskets. So 520 baskets. Now, the question has the target that you should find the break-even quantity for each individual product. But you have first, because the idea is like you are selling them in some fixed form, so you thought it wise to, box them, put them in a basket. So you have found the number of baskets to sell. Now you have to open all the baskets. when you open the basket, let's see how we can split this. We can get the individual products, the quantity of the individual products from this basket. So XU, YU, ZU. $520 baskets. Each basket has 2 XUs. So when we open all the baskets, all the 520 baskets, which contains 2 XUs in each basket, how many XUs would we get in the end? It will be 2 times 520. Is that correct?
Yes, sir.
Okay. Then when we open all the baskets, we will find 2 YUs in each of the baskets. So it will be 2 times 520 also for YU. When we open all the baskets, we will see 5 ZUs in each of the baskets. So 5 times 520. This one will give 2 times 520 will give us what? 1040. This will also be 1040. 5 times 520 will be what?
2,600.
2,600. Okay, 2,600. I usually forget of the total. Now we can bring a total here where we try to, okay, we will produce 1040 of XUs, 1040 of YUs, and 2,600 of ZUs to break even. In total, what would they be? 1040 plus 1040 plus 2,600.
4680.
4680.
Okay, so 4,680 individual, all the pieces combined. So that's how you do them. The emphasis is on these ones. How many units of each of the products should be sold to break even? You first did the calculation by calculating the bags, because you consider it as, okay, we are selling in a fixed proportion, constant sales mix. So it's like I find the proportion 2:2:5. So it's like a basket that I put 2 of this, 2 of that, and 5 of that, and seal the baskets, and I sell the baskets. To break even, I have to sell 520 baskets. I've sold the 520 baskets. When I open the 520 baskets, this is the individual products. That you are fine. That's a sure way. It gives you an accurate figures. Okay. Another approach, if you don't want to go by the basket approach, is to go by what is called the weighted average contribution per mix. Or basket in this case. Weighted average contribution per mix. We have already calculated the contribution per mix. What is the figure? I'm testing you if you are following. Contribution per mix. What was the figure?
6.25.
6.25. Correct. Who said 6.25?
Humphrey.
Humphrey, I'll give you 2 marks free. For following. So the contribution per mix, which is the same as contribution per bag, and we all calculated it together. So I was expecting you to know it. It's this: XU, ZU, YU, ZU. They all bring in contributions, and then we calculated them. We had 6.25. This one. That's the contribution that each bag is carrying. That's the contribution per mix. Contribution per mix. Contribution per basket. Follow the logic we are trying to build so that you don't get confused, please, I beg you. Because it's not difficult, but if you don't follow, if you follow and get the logic, it is very easy analysis to do. If you don't follow, It may be the most difficult thing for you on this planet, but it's not difficult. Now, related to the contribution per mix, as you know how to calculate already, is the concept of weighted average contribution per mix. So the only thing that has been added to it is WA in the northern region. Weighted average. You know the contribution per mix. You know this one. Contribution per mix. We are only adding weighted average. If you don't want to go the bags approach, you calculate the number of bags or baskets, then you open each basket and count the individual product. If you don't want to go by that approach, then another approach you can use is the weighted average contribution per mix. That one will give you this figure straight away. It will give you all of the products combined, the unit of all of them combined. Then you come and sort them out in the proportion that you sold them. So it's like the mirror image of themselves. So we are doing the same thing. Weighted average contribution per mix is equal to the contribution per mix or baskets divided by number of units in the basket, in the mix or basket. So in this case, we will have the contribution per mix was calculated at 6.25 divided by the number of units in the mix, 2 plus 2 plus 5, 9. So what will this figure give us? Weighted average contribution per mix. What will this figure give us? 6.25 divided by 9.
0.694.
A bit also.
Yes. Yes.
4. Okay, so let's do it this way. In exam, when you round, no problem. But for teaching purposes, I want you to confirm that this approach will yield the same as what we have done already. So, someone should give me the exact numbers on his calculator. 0.694. How many fours? Count the fours and give them to me.
The first as
1, 2, 3, 4, 5, 6, 7, 8.
So 8 fours, right?
Eight fours.
I think there will be different depending on the size of your calculator. 8.
Yeah, 8. This will have 12.
Okay. Because you are using a wider calculator. So it doesn't matter. Those who have 8, it means that the ones that will not show, it is in the memory of the calculator. So when you use the figures as it appears on your calculator, the full figures will be used. So you don't worry. Let me write 0.694, all right?
Okay.
But when I am calculating, I'll use this whole figure. I'll use this whole fraction to do it. So this is the weighted average contribution per mix. In exam, you have to round it, so 0.694 will be correct. But for teaching, for you to confirm that they yield the same results, I'll be using the whole figures. I'll be using the whole fraction, not the converted, the rounded one. So now, if we go by the weighted average contribution per mix approach, our break-even quantity, this time round, I will not put basket here because you are not calculating in basket. It will yield total quantity for all the 3 products. It will be equal to fixed cost of 3250. Is that correct? 3250. Yeah, 3250. Fixed cost of 3250 divided by 6.25 divided by 9. So please punch your calculator in this way for me. Do it 3250 divided by into brackets. Please, are you following?
Yes, sir.
Yes, sir. You are following, sir.
Yes. Punch it this way. 3250 divided by bracket open 6.25 divided by 9 bracket closed. And press enter. What did you get?
4680.
4680.
Okay, now let's see this 4680, whether we have found it somewhere before. 4680. Have you seen that?
Yes, total.
Have you seen this?
Yes, sir.
Yes, we had earlier calculated this through the box approach. The WAC per mix, weighted average contribution per mix, gives us that figure straight. If you had used the rounded weighted average contribution per mix, maybe your value will be slightly short of this. But in exam, that is okay because it's correct. But I want you to confirm that the approaches are the same. They give you the same results. Is that correct?
Yes, sir.
Yes, sir.
Yeah.
So
now,
this one should be in units, sir.
Yes,
4,000.
units. Units. In units. By this one, you cannot say it is ZU or U or ZA. It's all of them combined.
Yes.
Okay, now we are coming to sort them. We know the ratio between them.
Yes.
2 for XU, 2 for YU, and 5 for ZU, a total ratio of 9. So this total, the fraction that comes from XU is, so let me do that here. XU, YU, ZU. The fraction of XU that is made of this total, or that is inside this total, is 2 over 9. Alright, this is also 2 over 9, 2 out of the total fraction, and this is also 5 over 9. So when I multiply 2 over 9 times 2 over 9 times 4, 6, 8, 0. 2 over 9 times 4, 6, 8, 0. 5 over 9 times 4, 6, 8, 0. Then I'll get the same as these ones that we earlier got. 1040, 1040, 2600. So let's do it. 2 over 9. So do it, bracket open, 2 divided by 9, bracket closed, times 4680. What did you get? Are you calculating?
Yes, sir.
Yes.
Yes, sir.
So you got
What did you get for X?
1040, 1040.
Okay, 1040. Let's do the same thing. In fact, these two figures are the same, so we get the same 1040 here too. Now let's do for YU. Bracket open, 5 divided by 9, bracket closed, times 4680 gives us 2600. 2600. Do you see that these figures are the same as the ones we calculated earlier?
Yes, sir.
Okay, so that is how you calculate the break-even quantities for the individual product in multiple product environments. Break-even quantities. You can go by the back approach, where you get the basket approach. Where you get a basket, then you open the basket to sort the products out according to the ratio of sales or the sales mix between them. You can also go about it from the perspective of weighted average contribution per mix. You will get total units for the 3 products combined, then you sort them out according to the ratio. And be careful. In this way, the ratio is 2/9. 2/9. The proportion that the product is bringing over the total times what we are sharing in the same way as I have showed you on the screen. Any questions so far? Any questions so far? Any questions? Hello? I'm waiting for your questions.
All right, sir.
That is good, right?
Yes, please.
Yes, sir.
Okay. So we have gotten the physical quantities to break even. The question can ask you the break-even revenues from each of the products. One approach is if you take XU, you multiply its break-even quantity by the selling price per unit. Selling price per unit of XU is 3 cedis. 3 cedis times 1040. It gives you the total revenue to break even. That should come from XU. You do the same thing for the 2 other products. But like we learned in the single product environment, there is also another approach. In the single product environment, the other approach was called contribution to sales ratio, which when you divide by the total fixed cost, you get the revenue straight. A modified version of that one is employed in the multiple product environment. So that one we calculated contribution to sales ratio. In the multiple product environment, you will calculate weighted average contribution to sales ratio. In American terminology, it is weighted average contribution margin ratio. They are the same. Don't get confused over these terms. Weighted average contribution margin ratio, weighted average contribution to sales ratio. And it is quite straightforward. It employs the same logic in the single product environment. The formula in the single product environment was contribution divided by sales. In other words, it was contribution per unit divided by selling price per unit. Here, what would it be? It can be computed as, we are just trying to be smarter around the formulas. It can be computed as the contribution per mix, because here we are not selling the products individually, we are selling them in a mix. So the contribution per mix divided by the sales revenue in the mix. Do you see the logic?
Yes, sir.
Who doesn't see that logic?
Sir, Peter.
Peter, you don't see the logic.
Sir, go back.
Hey. So if I had not asked, you would have made me go forward. Okay, let me go back. In the single product environment, do you remember that we said that contribution to sales ratio is equal to contribution per unit divided by selling price per unit? Do you remember this?
Yes, sir.
Okay. In the multiple product environment, we are not dealing with contribution per unit of a product. We are selling them in a mix, in a basket. So this one will be substituted for contribution per mix or basket as we used. And then this selling price will be substituted for sales or revenue in the mix or basket. Do you now see the logic?
Yes, sir.
Okay. So that's just what we are doing. We are not doing things too different. We are just manipulating it because this is multiple products and the idea of constant sales mix. So we are doing things in a basket, so to speak. So we go around the same logic and then we do it. Our contribution per mix has already been calculated. This one was 6.25. So it is just the sales revenue in the mix that we have to go and calculate. If you go inside the mix, we have 2 from XU, 2 from YU, and Z from 5 from ZU, right? And
Yes,
each
sir.
one has its own revenue. So let's do it. Revenue in the mix. Revenue in the mix. XU, YU, ZU. So let's do it. Quantity in the mix. Quantity that they are bringing. This is bringing 2. This is bringing 5. Then selling price. If you go back to the question, we'll see the selling price. 342. 342. They are multiplying. So this one will give us 6 revenue, 8 revenue, 10 revenue. So revenue in the mix will be the sum of the individual revenues. This will give us 18, 20, 24. Am I correct?
Yes, sir. Yes, sir.
Okay. So revenue in the mix is 24. Now let's go back. Your formula is contribution per mix divided by revenue per mix. Quite logical from the same old story. So that will be 6.25 divided by 24. What will this give us?
0.2640.
0.2640.
04. 0.26.
260.
2604. 260.
2604166.
Okay, there are a series of numbers.
Yeah.
Yes.
Okay, so let's say approximately 0.26. But just to confirm the figures, when I'm using, I'll use the full figure, right? Just to confirm. But in exam, if you had rounded it, that will be fine. So approximately this. So this is weighted. This is called weighted average contribution to sales ratio. In American terms, it is weighted average contribution margin ratio. Contribution per mix divided by revenue per mix. It's as simple as that. But before we do this to get a revenue, let's compute how we would have gotten the revenue from the tradition or the normal way. We have the break-even quantities here. So here, let me fix it here. Revenue, break-even revenue from each of the products. This one would have been selling price per one is 3. This one is 4. This one is 2, I think. So let me clear 2.
It's 2.
Yeah. So revenue would have been 3 times 1040.
3120.
3120. Good. 1040 times 4.
4160.
4160. Good. 2600 times 2.
5200.
5200. Great. This would have been the revenue. We want to compute these same revenues from the concept of weighted average contribution to sales ratio. This is how we calculate it. So we would have gotten this ratio, this figure. When you divide the total fixed cost, so break-even revenue, using this approach would have been total fixed cost divided by weighted average contribution to sales ratio, which will be 3250 divided by 6.25 divided by 24. So let's compute it like this. I don't want to use the rounded figure because we have to go and confirm the figures there. So take your calculator, do it like 3250 divided by bracket open 6.25 divided by 24 bracket closed. You will get total revenue for all of the units for all the three products generated as
12,480.
What did you get?
12,480.
Okay, I think I didn't type my figures well. Let me. It's 3250. Yes, you will get. Thank you very much. You will get 123,840. Is that what you got? Did you get this?
12480. 12,480. That's what I had.
Okay.
1,
2, 3, 2. Yes, 1. Good. 12480. This one, right?
Yes.
Yes, sir.
Good.
Yeah.
So this will be the total revenue generated for all the three products for all the units involved. And now you have to come and share this revenue to the three products in the proportion of their sales mix revenue wise, not the physical product wise. Please, I want you to take your time and get these things so that you don't confuse yourself. Sales revenue, the mix, physical product wise was 2,000 units, 2,000 units, 5,000 units, which gave us 2:2:5. When you are sharing this revenue, we share revenue according to revenue proportion, not physical product proportion. We don't compare apples with pineapples. We do it on a level basis. So we have to go and find the sales mix revenue wise. Let's go back to the original question. When I was even setting the question, that's how I structured the question. Let's go back to the requirement. So you realize I told the students to do this. Determine. Oh, okay, not exactly. I'll give you another question. And another question, I structured it step by step. So we have to go and compute the sales mix revenue wise. It is as simple as this. Let's compute the sales revenue for each of the products by multiplying the physical units sold by the selling price per unit. So this will be, for XU will be 6,000. So it will be 6,000 is to 8,000, that is 4 times 2. So 6,000 is to 8,000 is to 10,000. You understand? So let's go, let me write it here. So the sales mix, I'm writing inside another thing, sorry. Sales mix revenue wise, XU, YU, ZU. Quantity 2,000, 2,000, 5,000. Selling price per unit 342. 6,000, 8,000, 10,000. So in gross terms, it will be 6,000 is to 8,000 is to 10,000. But you can reduce this. You can take divided by 1,000 to take the 3 zeros. So you get 6 is to 8 is to 10. 2 can go through all these numbers. 2 goes here. 3 is to 4 is to 5. So this becomes the reduced version of the mix revenue-wise between them. So this is the mix you will use. This is the ratio you will use to share the revenue of 480, sorry. And when you do that, it has to go and confirm these ones we calculated. These ones. So let's do that. So when we are given to XU, the total revenue there, the proportion coming from XU, the total of this will be 3 plus 4 will be 7 plus 5 will be 12. Am I correct?
Yes, sir.
So the proportion of the total revenue that comes from XU will be 3 over 12. This will be 4 over 12, 5 over 12. And we are sharing 12,480. 12,480. 12,480. 12,480. 12,480. When you multiply this, that should be the share. So take your calculator, do bracket open, 3 divided by 4, bracket closed, 12,480. So I'm doing the same thing, I'm following you. 3 divided by 12.
The first one will be 3,120.
So 3,1. Read it, the individual figures. 3,120.
3,120, yeah.
Okay, let's go and confirm that one. When you do for the rest, you will get the same figures as this. The other one is 4 divided by 12 times 12,480. You will have to get 4160.
4160.
Someone exactly 4160.
Yes, 4160.
Exactly. So these are the approaches. If you take your time to understand them, you realize that it is not too difficult a concept. It is not a difficult concept at all. Just see how it flows. As I have taken my time to take you through. Once you see how it flows, no question can beat you. And on top of what we have learned, please, when you go home, I'll give you other materials to read. I'll find some other materials that I deem may be useful. Do well to read small every day. I understand that a lot of things are taking our time. Family demands, job demands, and on top of this, we also have to enjoy ourselves. They also place demands on our time. But
very necessary.
Very necessary. But we still have to be reading small. Reading is what feeds our mind. We can't feed our stomachs and make our minds go hungry. That is a very criminal thing to do. So let's be reading small. So I'll find the material about this question. I prepared some small notes. It's already there. Get that one, read. That material is structured around the solution we have had so far. So you will confirm your understanding of what we have discussed. Plus, maybe I'll give a reference to some other textbook that you can read from and just get a very complete understanding of the concept. Any questions so far? Okay, no question. It also means that when we are taxed to go beyond, this one we have assessed the break-even situation in multiple product environments. When we are asked, okay, what is the quantity for each of the 3 products that must be sold to earn a targeted profit of this much? It flows. It's very straightforward. To earn a targeted profit from the single product environment, it is So quantity to earn, let's say, a target profit, it is the total fixed cost plus that target profit divided by the contribution per unit. But you will have to understand that in your case, it will be contribution per mix. Are you following?
Yes,
Please,
sir.
are you following?
Yes, sir.
It will be contribution
Yes, sir.
per mix.
Yes, sir.
And that contribution per mix, you should have already calculated it. If you are asked, calculate the quantity to sell to earn a targeted profit after tax, it will be, so Q to earn some profit after tax is equal to the total fixed costs plus the parts divided by 1 minus tax rate, all divided by contribution per mix. So you see that the only difference is the per mix. Per mix is not per individual product contribution. Contribution for the whole mix, for the whole basket. Is this then too difficult to understand? I need your candid reply. Is it too difficult to understand?
Oh, sir.
So when you say there is difficulty, I think, as you said, you need to practice constantly. And then
Exactly. So I will advise that you form teams. I understand we are all family. We are big people. Some of you are even managers. So the whole of the organization is in your care, plus the whole of your family. I understand. So what we can do is, just like we are doing now, you can form teams and do some discussions, some virtual discussions. You can use the link I gave you. When you click on it, you can meet yourself. So you can give yourself time. Okay, let's go through this piece of material. Blah, 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 blah. Small. The start may not be perfect, and don't expect perfect. Small. You'll be shaping yourself small. But do it with a mind to get something. Don't just do it for the sake of meeting. That one is time wasting. When you do it, that's one small. There's nothing that you cannot do. Even in the midst of all the pressure, if you do it small, you can do great things. It will surprise you. So this is where I end the lecture for today. Hey, I still have more time. I'm supposed to close at what?
2.
3 o'clock.
2.
Close at 2 o'clock.
Yes, sir.
Wow.
Yes, sir.
I have
Yes, sir.
done magic. I've been able to complete it. Okay, maybe there is something else to do because based on the.
Thank you.
Henry,
I'm listening.
what did you say, Kai?
Yes.
I in fact, the slide that we were given was given to us to base our teaching on, or to guide our teaching. I saw, in addition to these 2 topics, I have just finished. I also saw budgeting. So I don't know whether budgeting is part of this week. If budgeting should be part of this week, that will be more. Maybe it's part of it because we teach 6 hours. It will be part. So we have to do budgeting. Are you ready?
Yes, sir.
Okay, Rosemary is ready. Are the rest ready?
Yes, sir. So we have no option.
Yes, sir, we are ready.
Yes, sir, we are ready.
Okay.
We are ready, sir.
So this is where we draw the curtains on cost volume profit analysis, both for single product and multiple product environments. If no questions, then I will want to briefly pause the lecture. You know why? I want to break the cost volume profit analysis video from the budgeting video.
Okay, sir.
Yeah. So that will require, because the software that is doing the recording for me is running on the background. So it means I have to pause it, and render the video.
He said, do it and come back.
Hey.
Sir, do it and come back. We are waiting for you, okay? We are waiting.
Or say you are tired.
Me too, I don't have an option. I don't have an option. I have to teach. But the problem is that I just have 1 hour to teach, 1 hour more to teach. If I stop the video, if I should do the rendering, that can take me getting to about 20-30 minutes, by which time we have just 30 minutes to do nothing. So this is what I'm going to do. I'm closing the lecture. Okay? I'm closing the lecture. Trust me, we'll do the budgeting. If you find a time to give me, yes, I'll do the budgeting lecture. And also remind me that I have to do the spreadsheet modeling of the CVP analysis to make it complete.
Okay.
Yes. So I'll add that one to the budgeting, and then you can give me some time, then I'll just trash that lecture off.
Okay.
The budgeting is a straightforward concept. It's not difficult. So we can do it in like maximum 2 hours.
Okay.
Yeah. So let's end the lecture here. Thank you very much. If there is no
Okay,
question.
thank you, sir. Thank you.
Thank you, sir.